Welcome to the program. Before we talk about what you need to do, what you need to build, or what you need to fix inside your lending business, you first need to understand why this law exists and what it actually says. Because once you understand the why, the what becomes much easier. In this module, we'll cover 6 key things: how India arrived at this law, what personal data actually means, the 3 players defined under DPDPA, the biggest mindshift this law creates, the right your customers now have, and finally, what is truly at stake when you get this wrong. By the end of the module 0, you'll have the foundation you need. And from module 1 onwards, we'll apply everything directly to how a lending business actually operates. So let's get into it. So let's start from the very beginning. Before we get into what you need to do, what you need to build, what you need to fix, you need to understand why this law exists. Because when you know the why, the what starts making a lot more sense. India did not wake up one morning and decided to write a privacy law. This was years in making, and honestly, it almost didn't happen 3 times. Let's go back to 2017. A retired judge named Justice K.S. Puttaswamy filed a petition challenging the government Aadhaar program. His argument was simple: the government cannot force citizens to give biometric data because privacy is a fundamental right. The Supreme Court agreed. All 9 judges. They said privacy is not just a good idea, it's the fundamental right guaranteed under the Indian Constitution. The judgment changed everything because the moment privacy became a fundamental right, India needed a law to protect it. In 2018, the government set up a committee. Justice B.N. Srikrishna chaired it. They produced a draft bill. It never passed. 2019, revised bill introduced in the parliament, never passed. 2022, another version, again never passed. There were debates about surveillance, government exemptions, and how much power regulators should have. It kept getting pulled back. Finally, in August 2023, the Digital Personal Data Protection Act was passed. That is the law we are talking about in this course. But here's something most people miss. The Act alone is not the full picture. Indian law of this kind have 2 layers. The Act sets the principles, the rules tell you how to comply with those principles. And for 2 years after the Act was passed, the country waited for the rules. Then in November 2025, after multiple draft rounds, the rules were finally notified. DPDP Rules 2025, Gazette number GSR 843E, published on the 14th of November 2025. 23 rules, 7 schedules, covering everything from how a notice must look, to how consent managers must be registered, to what counts a reasonable security, to how breach must be reported, to how long you can keep the data after a customer relationship ends. If the Act tells you what privacy looks like, the rule tells you exactly what compliance looks like in practice. For lending businesses, the rules are where the operational specifics live. The enforcement is phased. This is important. You should not think of DPDPA as a big switch that flips on a single day. From the day the rules were notified, 14th November 2025, 3 things came into effect immediately: the definition, the data protection board, and the actual procedures and miscellaneous provisions. 1 year from the notification, that is by November 2026, the Consent Manager framework goes live. This is a new infrastructure for managing consent across platforms. We will talk about consent managers in details in lesson 3. And 8 months from notification, by May 2027, the big operative obligation come into force. That is when the consent rules, the notice requirements, the obligations on you as a data fiduciary, the rights your customers can exercise, and the penalty regime, all of it becomes enforceable. That last date is the one you need to circle, May 2027. That is the date your lending business has to be ready by. So here's where we are today. A lot of business right now are still waiting for the first penalty, waiting to see who gets caught first. That is the wrong bet. The Act exists, the rules exist, the dates are gazetted, the clock is running. That work that DPDPA requires: consent architecture, data mapping, updating notices, renegotiating LSPs and vendor agreements, building audit trails, none of this is 1 week project. For lending businesses, this is 6 to 12 months of focus work, sometimes longer. So the question is not whether this applies to you, the question is how ready you are when the operative provisions kick in. That is what this course is going to answer. In the next lesson, we will get into specifics. What exactly counts as a personal data in your business? And the answer will probably surprise you. Let me ask you something. When you think about personal data, what comes to your mind? Name, phone number, email address, maybe Aadhaar. That's what most people think. And that's exactly where most lending businesses get into trouble. Because under DPDPA, personal data is defined much more broadly than that. And if you're only protecting the obvious stuff, you're already exposed. The personal data is any information that can identify a person directly or indirectly. Directly is the obvious part. Name, phone, email, Aadhaar number, PAN. If I give you that data, you know exactly who I'm talking about. Indirectly is where it gets interesting. Your app tracks location, that's personal data. Your website captures IP addresses, personal data. Your system stores device IDs, personal data. You record purchase history, personal data. You track how a user behaves inside your app, what they click, how long they stay, what they search for, all of that personal data. Think about a lending business for a second. Before a customer even applies for a loan, you probably already have their location from the app installed, their device ID, their browsing behavior inside your app, and maybe a soft pull on their credit profile. That's 4 categories of personal data collected before a single form is filled. This is the part most lending businesses miss when they think about DPDPA. They think the law applies to the data they consciously collect. It applies to all of it. So within the personal data, there are categories that carries even higher obligation. Sensitive personal data. This includes financial data, health records, biometrics, fingerprint, face scan, iris, religious beliefs, and political opinions. For a lender, financial data is the big one. Income, bank statements, credit history, loan repayment behaviors. All of this sits in the sensitive category, which means how you collect it, store it, and share it carries stricter requirements. Now let me cover 2 terms that confuse a lot of people. First, anonymized data. This is the data where identification is genuinely impossible. Not difficult, not unlikely, impossible. If you process a dataset and there is absolutely no way, even with additional information, to track it back to an individual, that falls outside DPDPA. You don't have the same obligation on it. But here's the catch. The bar is very high. Most businesses think they anonymize the data when they just remove the name and the phone number. That is not anonymization. If I can cross-reference your data set with another data set and identify someone, it is personal data. Second, pseudonymized data. This is where you replace identifying information with a code or a token. So instead of storing Rahul Sharma, you store user ID 4821. Feels anonymous, but it's not. Because the mapping exists somewhere. Rahul's real details are still linked to user ID 4821 in another table. The identity can be reversed. Under DPDPA, pseudonymized data is still personal data. It does not get any exemption. So what does this mean for you practically? Go look at your product right now. Every screen where data enters your system, every API call you make to a third party, every field in your database, ask one question for each. Can this alone or combined with something else identify a specific person? If yes, it's personal data and DPDPA applies to it. This exercise alone will show you that your data footprint is much larger than you thought. In the next lesson, we'll talk about 3 players in the DPDPA ecosystem. Because once you know what personal data is, you need to understand who is responsible for it. And the answer might not be who you think. Every time a personal data moves, someone is giving it, someone is controlling it, and someone is handling it. DPDPA gives each of these roles a specific name and, more importantly, specific obligation. Get this wrong, meaning misunderstanding of which role you play, and you'll build your compliance program on the wrong foundation. So let's go through each one clearly. The first player, the data principal. This is the individual, the person whose data it is. Your customer who applied for a loan, an app user, your website visitor, your employee. Under DPDPA, the data principal is not just a passive source of data. They have rights. The right to know what data you hold, the right to correct it, the right to ask you to delete it, the right to withdraw consent they previously gave. We'll go deep into the rights in lesson 5. But for now, just understand the data principal is not just someone you collect the data from, they're someone who can come back to you and ask questions. And you must have answers. The second player, the data fiduciary. This is you, the business. The data fiduciary is the entity that decides why a personal data is collected and how it is used. The word decides is the key one here. If you build a lending product and you decide to collect income data to assess credit worthiness, you made that decision. You are the fiduciary. If you decide to pull bureau reports on your customer, you made that decision. You are the fiduciary. The obligation sits with whoever makes the decision about the purpose and the use. That is almost always the business. Now with data fiduciary, there is a subcategory called the significant data fiduciary or SDF. The government can classify certain fiduciary as significant based on the volume of data they process, the sensitivity of the data, the risk to national security, or the potential impact on rights of individuals. If you're classified as an SDF, you have the additional obligation on top of everything else. You must appoint a data protection officer. You must conduct periodic data assessment impact assessments. You must have systems independently audited. For lending businesses, financial data, biometric data from eKYC, large volumes of customers, the likelihood of being classified as SDF is high. Even if you're not classified today, you should build as if you will be. The third player, the data processor. This is the one who processes the personal data on your behalf based on your instructions. Your cloud provider, your KYC vendor, bureau integration partner, collection agencies, LOS providers, or your CRM. None of them decide why the data is collected. You do. They just process it based on what you tell them to. Here is the critical point that most businesses miss. Just because someone else is processing the data does not mean the liability transfers to them. You are the fiduciary. They are your processor. If they mishandle your customers' data, the primary obligation still sits with you. You choose that vendor, you gave them access, you are responsible for what they do with it. This is why your vendor agreement matters far more than most businesses realize it right now. We will spend a full module on this later in this course. Now let me quickly cover two more players you'll hear about throughout this course. The consent manager. This is a new concept under DPDPA. A consent manager is a registered intermediary registered with the Data Protection Board that manages consent on behalf of data principals across multiple platforms. Think of it like a single dashboard where a customer can see all consents they've given to different companies and revoke any of them in one place. This framework comes live in November 2026. As a fiduciary, you may eventually be required to integrate with registered consent managers. The Data Protection Board, or DPB, this is a regulator set up under DPDPA specifically to handle complaints from data principals, investigate violations, and issue penalties. If a customer feels their rights were violated and you did not resolve their grievance, they can go to the DPB. The DPB can investigate you, ask for documents, and impose fines. And one more role that sits inside your organization, the Data Protection Officer, DPO. For significant data fiduciaries, appointing a DPO is mandatory. For others, it's strongly advisable. The DPO is the internal person who owns the DPDPA compliance. They are the point of contact for DPB. They oversee your consent systems, handle DSARs, manage breach responses. This is not just a title. Under DPDPA, the DPO carries real accountability. Now here's something worth noting. One entity can play multiple roles depending on the context. If you're an NBFC that lends directly to the customer, you are a fiduciary. If you also process loan data on behalf of a co-lender, you are a processor for that relationship. Same company, two different roles, two different sets of obligations. The role is defined by the relationship and the data flow, not by what your business card says. In the next lesson, we'll talk about something that fundamentally changes how you think about every data decision you make. The shift from unless forbidden to only if permitted. It's the biggest mindset change this law brings, and most businesses have not fully absorbed it yet. This lesson is the most important one in Module 0. Not because it has the most information, but because if you don't absorb what I'm about to say, every other lesson in this course will feel like a checklist you're filling out without understanding why. So stay with me here. For the last 2 decades, the way Indian businesses operated with the customer data followed one simple logic. Collect whatever you want, use it however you want, unless a specific law says you cannot. That was the default. Data collection was open unless explicitly restricted. Your sign-up form asked for 40 fields even though you only needed 10. You shared customer data with a partner without telling the customer. You kept customer data forever even after the relationship ended. Nobody told you not to, so you did it. That logic is now dead. DPDPA flips the entire model. The new default is this: you cannot collect, process, store, or share personal data unless you have a lawful basis to do so. Not unless it's forbidden, only if it's permitted. This is not a small change. This is a complete reversal of how you need to think about every data decision your business makes. Now, under the DPDPA, there are 2 lawful bases, 2 situations where processing personal data is permitted. The first and the primary one is consent. The customer explicitly agrees. They know what data you're collecting, they know why, they know who you'll share it with, and they say yes, clearly, specifically, without any ambiguity. Not a pre-tick checkbox, not buried in 40 pages of terms and condition, not assumed because they downloaded your app. Explicit, informed, specific, unambiguous. If those 4 words are not all true at the same time, you don't have a valid consent. And if you don't have a valid consent, you don't have the lawful basis to process. The second lawful basis, legitimate use. This covers specific situations where consent is not required. Complying with a court order, performing a function required by the law, a medical emergency, employment-related processing, state functions. For lending business, the most relevant one is legal obligation. If RBI requires you to retain certain loan records, that is a legitimate use. You don't need a customer's consent to retain what regulation mandates you to retain. But, and this is important, legitimate use is a narrow curve out. It's not a backdoor to avoid getting consent. You cannot stretch it to cover general business operations. Now let me introduce you to one more concept here, the consent artifact. When a customer gives consent, that moment must be captured and stored as a consent artifact. Think of it like a receipt of consent. It must contain what data the customer agreed to share, the purpose they agreed to, which notice version they saw at the time of consent, the channel through which the consent was given, and the exact timestamp. Why does this matter? Because the day a customer disputes consent, I never agreed to this, the consent artifact is what you produce. It is your proof. Without it, you have nothing. In lending business, this becomes very specific. Every bureau pull needs a consent basis. Every data share with a co-lender needs a consent basis. Every third-party tool you use, Karza, Perfios, your insurance cross-sell partner, needs to be named in the consent the customer gave. If it's not named, it's not covered. Let me give you a practical way to use this in your business. Go through every place where your system processes customers' data. For each one, ask 2 questions. 1. Do I have a lawful basis for this? Either consent or legitimate use. 2. Can I prove it? Is there a consent artifact, a regulatory requirement, a documented legal basis? If the answer to either question is no, that is a gap. And that gap is your liability. This exercise is uncomfortable because for most businesses, a significant portion of current data processing has no documented lawful basis whatsoever. That's not a criticism, that's just where we are. The law changed, the default changed. Now the work is to catch up. The good news is it's fixable. That's what the rest of this course is for. In the next lesson, we'll talk about the right the data principle now holds. Because understanding what your customer can demand from you is just as important as understanding what you must do proactively. So far in this module, we've talked about the law, the data, the players, and the lawful basis. Now let's talk about something that will directly land into your inbox one day, if it hasn't already. Customers' rights. Under the DPDPA, the person whose data you hold, the data principle, is not a passive participant anymore. They have specific legally backed rights. And you must have a process to handle each one, not optional. Not we'll figure out when it happens. A process. Today, right to access. A customer can come to you and say, what data do you have on me? And you must tell them clearly in a reasonable time frame. For a lending business, think about what that actually means. You may hold their loan application data, income documents, bank statements, bureau pull history, eKYC data, call recording, communication logs, behavioral data from your app, third-party enrichment data from your TSPs. All of that, a customer can ask to see it. Do you have a system today that can pull all of that together in one place? Most businesses don't. That's the gap. Right to correction. If a customer believes the data you hold is inaccurate or incomplete, they can ask you to correct it. The income figure is wrong. Their address is outdated. A field was filled incorrectly during onboarding. You must have a process to receive that request, verify it, make the correction, and document what changed. Before state, after state, who made the change, when. And in lending, correction is not just a CRM update. It may cascade to your LOS, your bureau reporting, your co-lenders records. The process needs to account for all of that. Right to erase. This is the one that makes most lending businesses nervous. A customer can request that you delete their personal data once the purpose of which is collected has been served. Loan is closed, relationship is over. Delete my data. Now here is where it gets nuanced. DPDPA says delete when purpose is served. RBI says retain loan records for defined periods. Income tax says retain financial records even longer. These are not in conflict. You retain what regulation explicitly mandates you to retain. Everything else, marketing data, behavioral data, third-party enrichment data that never required for the loan itself, gets deleted. You need to know exactly which bucket each data type falls into, because we keep everything just in case is not a valid answer anymore. Right to nomination. This one is less talked about but worth understanding. A data principal can nominate another person to exercise their data rights on their behalf in the event of death or incapacity. Think of it like a data nominee, similar concept to a bank account nominee. For most businesses today, this is not an immediate operational pressure, but you need a mechanism to support it, especially if your customer base includes older individuals or anyone with health vulnerabilities. Right to grievance redressals. Every data fiduciary must have a mechanism for customers to raise complaints about how their data is being handled. This is not a suggestion, it is a requirement. You need a named point of contact, a defined process, a response timeline, a documentation on how each grievances was resolved. If a customer raises a grievance and you do not resolve it to their satisfaction, they have the right to escalate directly to the Data Protection Board, which brings us to the last right to approach the DPB. If you as a fiduciary fail to address a complaint, the customer can go to the Data Protection Board directly. The DPB can then investigate you, ask for documents, call for explanation, and if they find a violation, issue penalties. This is not hypothetical. This is the enforcement mechanism that the law has built. Now here is one more category I want to cover here separately because it carries its own specific obligations. Children's data. Under DPDPA, anyone under 18 is classified as a child, and processing their data requires verifiable parental consent. Not just a checkbox that says, I confirm I'm above 18, verifiable. Beyond consent, you cannot process children's data for behavioral tracking or targeted advertising. For most lending businesses, children are not direct customers. But if your platform has any feature that could be accessed by a minor, a co-applicant, a nominee, a family member, or a joint account, you need to think about this. And before I move on, one thing I want you to sit with. These rights creates inbound demand on your operations. Access request, corrections request, erase request, grievance complaints, these will come. The businesses that build process for them now will handle them smoothly. The ones that don't will scramble every single time. One more lesson to go in Module 0. In Lesson 6, we talk about the penalties, the Data Protection Board, and what the enforcement timeline actually looks like. Because understanding what is at stake is what makes everything in this course feel urgent rather than academic. We've covered the law, the data, the players, the lawful basis, and the rights. Now let's talk about what happens when you get it wrong. Because I want to be honest with you here. A lot of businesses are still treating DPDPA the same way they treated GST in 2016. They know it's coming, they're vaguely aware they need to do something, but there's no urgency because nobody has been penalized yet. That thinking has a shelf life. And with the rules now notified and the dates locked in, the shelf life is shorter than most people realize. So let's talk about the penalty structure first, because the numbers matter. Under DPDPA, penalties are not a flat annual fee. They are per violation. Every instance of non-compliance has a separate exposure. Let me walk you through the key ones. Failure to implement adequate security safeguards. This is the big one, up to 250 crores. If your systems are breached because you did not implement reasonable security measures, data encryptions, access controls, vendor security standards, this is the penalty you're looking at. For context, 250 crores is not reserved for large enterprises. The law does not have a turnover threshold. A fintech company with 50,000 customers and weak security infrastructure is just as exposed as a large NBFC. Failure to notify a data breach, up to 200 crores. The breach happened. That's bad. But not notifying the Data Protection Board within the required window, that's a separate violation. And not notifying the affected customer, another separate violation. 3 violations from 1 breach. The penalties can stack. Non-compliance with children's data obligation, up to 200 crores. Non-compliance by a significant data fiduciary, up to 150 crores. Smaller procedural violations, 10 to 50 crore range. Not maintaining records properly, not having a grievance mechanism, not responding to a customer's access request in time. And I want to repeat this because it's important. These are per violation, not per year, not per company, per violation. If you have 10,000 customers and you've collected data from all of them without a valid consent, that is potentially 10,000 violations. The math becomes uncomfortable very quickly. One breach notification, the rules notified in November 2025 are very specific. Rule 7 lays it out. The moment you become aware of a personal data breach, you have 2 notification obligations running in parallel. To affected customer, you must intimate without delay. The notice must describe the breach, explain the likely consequences for them, tell them what you've done to mitigate, what they can do to protect themselves, and give them a contact point for questions. To the Data Protection Board, you have 2-step obligation. An initial notification without delay, and a detailed report within 72 hours of becoming aware. And separately, if you're a lender, certain rules under the IT Act already requires you to report cybercrime incidents within 6 hours. That obligation is independent of DPDPA. So a single breach can trigger 3 notification clock, the 6-hour certain clock, the without delay customer notification, and the 72-hour DPB report. This is exactly why you need a breach playbook before something goes wrong, not after. Now let's talk about who actually enforces this Data Protection Board. The DPB is a regulatory body set up specifically under DPDPA. It's not SEBI, it's not RBI, it's not MITI directly, it is an independent advisory body. And the provision established the DPB came into force on 14 November 2025 when the rules were notified. So the board now formally exists. Here is how it works. A customer raises a grievance with you. You do not resolve it. They escalate to the DPB or, and this is important, the DPB can take suo motu cognizance, meaning they don't need a customer complaint to investigate you. If they became aware of a potential violation through any means, they can initiate proceedings on their own. They can ask you for documents, they can call for explanation, they can inspect your system, and if they find a violation, they issue penalties. The DPB also has an appeal structure. If you disagree with the DPB order, you can appeal to the Telecom Dispute Settlement and Appellate Tribunal, the TDSAT, and from there to the High Court. But getting to that stage means you're already in a formal regulatory proceeding. This is not a position any lending business wants to be in. Let me bring back the dates one more time because the timeline is the most important thing for you to internalize. 14 November 2025. Definition, the Data Protection Board and the procedural pieces are already in force. November 2026, the Consent Manager Framework comes live. 1 year from notification, May 2027, all operative obligations. The consent rules, the notice rules, the obligation on you as a fiduciary, the SDF rules, the right your customers can exercise, and the penalty regime, all of it enforceable. 18 months from notification, if your lending business is not ready by May 2027, you are exposed. Module 0 is now complete. You know why the law exists. You know what personal data means in your context. You know who the players are and what role you play. You know the two lawful bases, you know what rights your customers hold, and you know what is at stake if you get it wrong. From here, we go into specifics. Module 1 takes everything we've just covered and applies directly to how a lending business actually operates. LSPs, bureau pulls, co-lendings, DSAs, third-party data tools. The lending specific layers for DPDPA. Let's get into it. That's Module 0. Take a minute, let it settle. And when you're ready, Module 1 is waiting. See you there. Welcome to the Module 1. In Module 0, we cover the law itself, the principles, the players, the rights. But this module is different. This module is about your lending business specifically. Because here's the reality. If you're already regulated, RBI has guiding lenders for years. Fair practice codes, KYC norms, outsourcing guidelines, data localization circular. So when DPDP arrives, the natural question becomes, what actually changes for me? That's exactly what this module answers. Across 5 lessons, we'll apply DPDPA to real operational parts of lending business. So let's get into it. Let me start this lesson with the most common confusion I see when I talk to lending business owners. They say, we already follow RBI rules. We have a fair practices code. We do KYC. We localize our data. Why do I need a separate compliance program for DPDPA? It's a fair question, and the answer matters. DPDPA is not a replacement for RBI. It is not a competing regulator. It is a separate parallel obligation that sits on top of everything you already do. Let's look at what RBI already governs. Fair Practices Code, KFS, KYC, outsourcing norms, data localization, digital lending guidelines, DPSS, rules for payment companies, the account aggregator framework. All of these are operational rules. They tell you how lending must be done, how disclosures must be made, how vendors must be managed, how money must move, how customers must be onboarded. This is the world you already live in. None of it goes away. Now here's what DPDPA adds on top. RBI tells you how to do lending. DPDPA tells you how to treat customer data through a completely different lens. RBI never gave your customer the right to come to you and say, show me everything you know about me. RBI never gave your customer the right to say, delete my data because the loan is closed. RBI never gave your customer a regulator they could complain to about how you handle their information. DPDPA does all of that. It creates a new set of rights for the individual. And it creates a new regulator, the Data Protection Board, that the individual can go to if they feel those rights have been violated. This is the gap that DPDPA fills, the customer dimension that was never explicitly there. Let me show you where the two overlap, because there are areas where you have to comply with both at the same time. KYC. RBI tells you what documents you must collect and how to verify them. DPDPA tells you how to get consent for that collection, how long you can keep the data, and when you must delete it. Both apply. Neither cancels the other. outsourcing. RBI says you cannot transfer regulatory responsibility to a vendor. DPDPA says the same thing, but specifically about data. If your LSP processes customer data, you remain the fiduciary. The accountability is on you. Breach reporting. This is where it gets layered. Certain rules already require you to report cyber incidents within 6 hours. RBI has its own incident reporting timelines for certain categories, and DPDPA adds a third clock without delay to the customer and within 72 hours to the data protection board. A single breach can trigger all three. So your incident response process needs to handle all three streams in parallel. Now here's the question I get asked the most. What if RBI and DPDPA actually conflict? What if RBI tells me to keep something and DPDPA tells me to delete it? Mostly they don't conflict. They layer. The classic case is loan data after loan closure. The customer comes back 6 months after closing the loan and says, delete my data. RBI says you must retain loan records for a defined period. Income tax says you must retain financial records for even longer. Here's how that resolves. DPDPA itself recognizes this. Retention required by another law qualifies as legitimate use under DPDPA. So you retain what regulation explicitly mandates you to retain. But, and this is the part most lenders miss, you delete everything else. The marketing data, the behavioral data from the app, the third-party enrichment from Karza or Perfios that was never required for the loan itself. None of that is mandated by RBI or income tax. So none of it gets the legitimate use exemption. It gets deleted. There is no real conflict. There is a hierarchy. Retain what regulation requires, delete the rest. So here's the mental model I want you to walk away with. RBI is about how you do lending. DPDPA is about how you treat the customer's data while you're doing that lending. Both apply, always. Your compliance program is the union of both, not the larger of the two, not whichever one is more convenient. The union. In the next lesson, we get specific about your role. Are you a data fiduciary, a data processor, or something else? For lenders, the answer is clear cut, but the implications are not. In Module 0, Lesson 3, we talked about the three players: data principal, data fiduciary, data processor. In a lending business, your role is clear. You are the data fiduciary. Always. This sounds obvious, but the implications of accepting that label are not obvious at all. And that's what this lesson is about. Let me re-anchor the test from Module 0. Under DPDPA, the fiduciary is the entity that decides why personal data is collected and how it is used. In a lending business, who decides any of this? You decided to ask for income proof. You decided to pull the bureau report. You decided which co-lender to share data with. You decided to onboard customers through an LSP instead of building your own funnel. Every meaningful decision about why customer data is collected and how it gets used, those are your decisions. So the role is yours. There's no ambiguity. Now, here's where most NBFCs and Fintechs try to find a loophole. They say, but we never see the customer. The LSP onboards them. The customer downloads the LSP's app, signs on the LSP's screen, reads the LSP's terms. We just receive the file for underwriting. And the implicit hope is, if the LSP collected it, maybe the LSP is the fiduciary, not us. That logic does not hold under DPDPA. The test is not who clicked the button. The test is who decided what data to collect and why. Who designed the loan product? You did. Who set the underwriting rules that determine what fields are needed? You did. Who decided to use this LSP versus another one? You did. The LSP is acting on your specifications. They are your processor. You are the fiduciary. The fact that the customer never sees your face does not transfer the role to the LSP. So what does it actually mean to be the fiduciary in operational terms? It means every DPDPA obligation lands on you first, establishing a lawful basis for every piece of data you process. Your responsibility. Writing the privacy notice and making sure it accurately covers what happens to customer data, yours. Responding when a customer asks to see all their data, you. Processing correction and deletion requests, you. Notifying the board within 72 hours when a breach happens, your clock starts the moment any vendor in your chain becomes aware. And the penalty exposure, also yours. Our vendor handles that is not a defense the DPB will accept. They will look at you because you are the fiduciary. Let me give you the practical picture. In a typical lending business, this is who your processors are. Your cloud provider, AWS, Azure, GCP, your LOS, CRM, every LSP and DSA you source from, your KYC vendor, every credit bureau you pull from, Karza, Perfios, FinBox if you use them, your collection agencies, your SMS and WhatsApp providers, your insurance cross-sell partners. Every single one of these is processing your customer data on your behalf. Every single one of them is a processor under DPDPA. And every single one of them needs an agreement that meets DPDPA requirements. We'll go deep on what that agreement must contain in Module 4. For now, just understand the scope. The list is longer than most lenders realize when they first do this exercise. Let me end this lesson with one sentence I want you to internalize. In a lending business, you are the fiduciary. Every vendor in your chain is your processor. Liability does not flow downstream. In the next lesson, we look at whether you might be classified as a significant data fiduciary, which adds a whole second tier of obligations on top of being a regular fiduciary. For most lenders, this question is not optional, it needs an answer. Module 0, Lesson 3, we introduce the SDF concept, Significant Data Fiduciary. In this lesson, we answer the practical question. Is your lending business likely to be classified as one? And what does that mean for what you need to build? First, how does someone become an SDF? The central government classifies. They look at 6 factors: volume of personal data you process, sensitivity of that data, risk to electoral democracy, risk to the security of the state, risk to public order, and the potential impact on the rights of data principles. And here's something important. The notification can name a whole class of fiduciary at once. It does not have to be company by company. So a notification could say, all NBFCs above a certain asset size are SDFs, or all digital lending platforms processing more than X customers per year are SDFs. That class-based notification is what most lending businesses should be planning for. Now apply those 6 factors to a typical lending business. Volume. Even a mid-size NBFC processes hundreds of thousands of loan applications a year. A larger fintech can do that in a quarter. Volume is not a defense for most lenders. Sensitivity. Financial data is explicitly sensitive under DPDPA. Bank statements, income, bureau scores, eKYC, all sensitive. Add biometric data from face match and fingerprint at onboarding. Also sensitive. Impact on rights. Think about what happens when lending data is mishandled. A wrong bureau report can damage creditworthiness for years. A leaked bank statement can lead to fraud. Mishandled Aadhaar data can lead to identity theft. On every dimension that matters, volume, sensitivity, impact on rights, lenders score high, which is why most observers expect lending businesses, especially digital lenders and large NBFCs, to be among the early SDF classifications. If you get classified as an SDF, 3 additional obligations kick in. These are not optional, they are not best practice, they are required. First, you must appoint a data protection officer, not in name, a real DPO, someone senior enough to challenge business decisions when needed, based in India, accountable to the board of directors, and listed publicly as the contact for any grievance. For most lending businesses, this means either hiring a dedicated DPO or making someone like the chief compliance officer or chief risk officer wear that hat formally, with a real reporting line to the board. Second, data protection impact assessments, DPIAs. We'll go deep on these in Module 4. For now, understand the trigger. Any significant processing activity needs a documented assessment. New product launch, new LSP partnership, new data category being added. Each one needs a DPIA before it goes live. Third, independent audit, periodic, conducted by a data auditor empaneled or accepted by the board. They will look at your consent flows, your data flows, your retention practices, your breach response. Their report goes to the regulator. So here's the practical position I want you to take. Even if you are not classified as an SDF today, build as if you will be. The reasons are simple. 1. Every SDF obligation is good practice anyway. Having a real DPO, doing DPI. As before launching new products, getting periodically audited. None of this is wasted work even if you're never classified. 2. Retrofitting is harder than building it in. If you've built consent architecture without DPIA discipline, going back and adding DPIAs to existing flows is painful. If you've never had a DPO, hiring one and bringing them up to speed takes months. 3. When classification happens, it tends to happen with a short runway. The notification gives you weeks, not months, to comply. If you're already operating to the SDF standard, classification is a paperwork update. If you're not, it's a fire drill. The cost of building to the SDF standard early is small. The cost of being classified and unprepared is large. Before we move to this next lesson, do a self-check. Do you have a named DPO with real authority? Not a ceremonial title? Do you do a documented DPIA before any new product or partner goes live? Have you had a third-party data audit in the last 12 months? Is your DPO's contact information public on your website so a customer with a grievance can find them? Each no is a gap. Each gap becomes urgent the moment you're classified. In the next lesson, we map out something every lender needs but very few have ready: the data flow map. If I had to pick one document that becomes the foundation of your DPDPA compliance, it would be this: the data flow map. Most lending businesses do not have one. They have pieces of one. The product team knows the entry points, the compliance team knows the regulatory data, the tech team knows the database, but nobody has the consolidated picture. Without that consolidated picture, you cannot build any of the other pieces. Not the consent architecture, not the privacy notice, not the breach response plan. So, this is the starting point. Start with entry points. Where does customer data first enter your system? In a typical lending business, many places. Direct app onboarding, website forms, DS, as filling forms on paper or digitally, branch walk ins, LSP platforms where customers sign on a partner's app, telecalling teams who capture data over the phone, referral partners who push leads to you, API integrations from co-lenders. Each one of these is a different entry point, different channel, different customer experience. And under DPDPA, each one is a separate consent event with its own notice version. If a customer comes through your app, they see one notice and give one form of consent. If they come through an LSP, they see something else. The consent artifact must capture which one applied to which customer. We'll go deep on this in Module 2. Once data enters, it moves through your processing systems: LOS, CRM, Bureau Pull APIs, eKYC, Bank Statement Analyzer, GST APIs, Account Aggregator Integration, Underwriting Engine, Disbursal System, Loan Management System, Collections Platform. Each step is doing something with the data. Each is a processing purpose, and under DPDPA, each purpose needs a lawful basis. You cannot pull a bureau report unless you have consent for that specific purpose. You cannot send the bank statement to Perfios for analysis unless the customer agreed to that. You cannot use behavioral data from the LMS for cross-sell unless that's named in your notice. This is why mapping the processing points matters. Each one is an opportunity for a lawful basis gap. And then, exit points. Where does data leave your system? Co-lender for joint loans, insurance partner for cross-sell, collection agency, recovery agent, legal counsel for litigation, bureau reporting, your monthly or reporting files, regulatory reporting to RBI, SEBI, GST, income tax, internal and statutory audit firms. Each exit is data going to a third party. And here is the rule that catches most lenders out. Each of these third parties must be named in your privacy notice. Each one needs a processor agreement that meets DPDPA standards. And each one must be disclosed in the consent the customer originally gave. Generic language like "we may share with our partners" does not work. Specific names, specific purposes, specific consent. Let me call out the specific third-party tools that touch lending data, because almost every lender uses some combination of these. Karza for KYC and document verification, Perfios for bank statement analysis, Experian for bureau and alternate data, CKYC for central KYC, CERSAI for collateral registration, MCA21 for corporate filings on business loans, Aadhaar eKYC providers, GSTN APIs, account aggregator integrations through Safe, OneMoney, and others. Open your current privacy notice right now. Are these names in there? Each one spelled out. If not, every customer whose data touch these tools without their explicit knowledge represents a lawful basis gap, multiplied by every customer. This is not theoretical. This is the most common single finding when a lending business does its first data flow audit. So here's why the map is the foundation. Once you have it, everything else falls into place. Your privacy notice has to name every party on the map, so the map drives the notice. Your consent design has to cover every entry point and every onward flow, so the map drives the consent architecture. Each processor on the map needs an agreement. The map gives you the list. Every DPIA you do is essentially asking, does this change the map? When a customer asks for their data, you search every node on the map. When a breach happens, you know exactly who to call at every node. Without the map, every other piece of compliance is guesswork. With the map, every other piece becomes a list. This is the single highest leverage exercise you can run in your business. We'll come back to it in Module 4 with a step-by-step approach. This is the last lesson of Module 1, and it's a practical one. DPDPA applies the same to a small fintech as to a large NBFC. The principles do not change. The penalties do not have a turnover threshold. But what compliance looks like operationally varies by scale. A 50,000 customer fintech doing two products has a different compliance bill than a 5 crore customer NBFC running 10 products with 20 co-lenders. same law, different reality. Let's walk through what minimum viable compliance looks like at each scale. Let's start with a small lender, up to about a lakh customers, one or two products, a handful of partners. Here is what minimum viable compliance looks like: a documented data flow map. We just covered why this matters. A revised privacy notice that explicitly names every partner, every bureau, every analytics tool, every co lender, every collection agency, product wise consent collection at every entry point, your app, your website, your DSAs, with a parallel revocation mechanism on the same channels. If consent goes in through the app, revocation must go out through the app. A named grievance officer with public contact information, real phone, real email, real person who actually responds. A DSAR process. When a customer asks for their data, you should target a 30-day turnaround as the working norm. Processor agreement updates with every current vendor. So each one explicitly takes on the obligations DPDPA expects, and a breach response playbook with named owners: who calls whom, who drafts customer notification, who notifies the board within 72 hours, who notifies certain within 6. Lean. But every item must be real. None of this can be on paper only. Now move up. Mid-sized lender, a lakh to 50 lakh customers, multiple products, several LSPs, co-lenders, everything from the small lender baseline still applies. But you add several layers on top. Consent has to be tracked not just per product, but per channel. The unique consent ID becomes essential. Every consent event must be uniquely identifiable. So when a dispute comes up, you know exactly which customer, which product, which channel, which notice version. A centralized consent registry inside your LOS, not consent records sitting in 15 different vendor systems with no master view, one source of truth. Privacy notice versioning. Every time you update it, you save the previous version, because the consent the customer gave was tied to a specific version, and you must be able to produce that version on demand. LSP agreements with audit rights and breach notification clauses, and you actually exercise the audit rights periodically. We'll cover these clauses in detail in Module 4. Co-lender data sharing agreements that include who handles a DSAR if the same customer's data sits with both lenders. And a quarterly DPDPA review cycle. Every quarter, ask: did we add a new partner? Did we launch a new product? Did we onboard a new LSP? Each one of those triggers a notice update and possibly fresh consent. Plus internal training. Your sales team, your ops team, your collections team, they all interact with customer data. They need to know what they can and cannot do. And then the largest tier, 50 lakh customers and above, many products, many partners, likely SDF classification, either today or in the next round. Everything from the previous tiers, plus a fully built program, a dedicated DPO, full-time, India-based, reporting to the board, with actual authority to stop a launch if the privacy posture is not ready. A formal DPIA process. Every new product, every new partner, every new system goes through a documented assessment before launch. An annual independent audit by an auditor recognized by the board, with remediation tracking on every finding. Automated DSAR fulfillment, because manual processes do not scale. When you have crores of customers, every DSAR cannot be a 5% fire drill. The system has to orchestrate the data pull from every vendor automatically. Real-time breach detection, monitoring on your databases, your APIs, your vendor flows, plus a tested incident response plan. Tested, not just written. Privacy by design review built into your product launch process. So privacy is considered before code is written, not after. Cross-border governance. If any vendor is offshore, that gets specific attention. And quarterly board reporting on DPDPA. Privacy is a board topic, not just a compliance team topic. This is a program, not a checklist. I want to leave you with one exercise. Ask yourself this question and be honest. If the data protection board walked into your office tomorrow and asked for documents, what could you not produce? Could you show them the data flow map for your top 3 products? Could you produce consent artifacts for the last 1,000 customers with the data, the purpose, the channel, the notice version, the timestamp? Could you show which version of your notice each of those customers actually agreed to? Could you produce a processor agreement with your largest LSP that has all the DPDPA clauses we'll discuss in Module 4? Could you show evidence of a DSAR you fulfilled in the last 30 days? Could you produce a breach response plan with named owners and tested timelines? Whatever you cannot produce, that is your roadmap. That is what you build first. This honest self-assessment is the most useful exercise in the whole course. Do it now. Make a list. Take it back to your team. That's module 1. You now understand how DPDPA sits on top of your existing RBI obligation. You understand your role as a data fiduciary and the responsibilities that come with it. You've also started thinking about whether your organization could be classified as an SDF and what that would mean. You've seen what a proper data flow map looks like, and now you have a clear sense of the scale of compliance your business may need. From module 2 onwards, we go deeper into one of the most operationally complex area for lenders under DPDPA: consent. Because in lending, consent is never just one consent, it's many. And getting this wrong is where a lot of enforcement risk begins. So see you in module 2. Welcome to module 2. This is where DPDPA starts becoming operationally complex for lending business. Because in lending, consent is not one thing, it is many different things. And honestly, most lenders start out doing this incorrectly, usually because they treat consent like a single onboarding checkbox. So, in this module, we'll go deeper into the details. We'll cover product wise consent, channel wise consent, the difference between universal consent and explicit consent, how bureau pools become complicated across the loan lifecycle, and what your privacy notice and terms of use must actually contain. If consent is the foundation of DPDPA, and it is, then this module is where you learn about how to build that foundation properly. So let's get into it. Let me start with the single most common mistake I see in lending businesses today. A customer signs up for a personal loan. They give consent. They get the loan. 6 months later, the same customer becomes eligible for a credit card. The team thinks, great, they're already our customer. They already gave us consent. Let's cross sell. So the team pulls a fresh bureau report, runs underwriting, and triggers a pre approved credit card offer. Under DPDPA, that is a violation. Even though the customer is yours, even though they gave consent for the personal loan, even though it's the same database, the same KYC, the same everything. Why? Because consent is product specific. Let me explain why this rule exists and what it means operationally. DPDPA defines what valid consent looks like with 6 words: free, specific, informed, unconditional, unambiguous, with clear affirmative action. All 6 have to be true at the same time. Miss anyone and your consent is not valid. The word that matters most for this lesson is specific. Specific means consent is tied to a specific purpose, not a general permission slip, not a blanket authorization. Specific. So when a customer agrees to share their data for a personal loan, that consent covers the personal loan. It does not automatically cover a credit card. It does not cover a home loan. It does not cover a top up. Each new product is a new purpose. Each new purpose needs its own consent. Same customer, 3 products, 3 consent records. Now I know what some of you are thinking. Why don't we just write a single consent at onboarding that says, I consent to processing my data for any current or future product the company offers? Then we're covered for everything, forever. That language fails the DPDPA test on 3 counts. It is not specific. Any product is not a specific purpose. It is the opposite of specific. It is not informed. The customer cannot give informed consent for a product that does not exist yet, that they have not seen, and whose data needs they cannot evaluate. It is not unambiguous. An open ended, future facing scope is the very definition of ambiguity. So, if you have language like this in your onboarding flow today, and many lenders do, it will not stand if challenged. You may have collected something, but what you've collected is not legally valid consent under DPDPA. Let me make this concrete with the cross sell example. You have a customer with a personal loan. They've been paying on time for 6 months. Your underwriting model flags them as eligible for a credit card. Before you do anything for the credit card, and I mean anything, you need fresh consent. Why? Because every operation involves a new processing purpose. Pulling a fresh bureau report for the credit card decision, that is data processing for a new purpose. Running credit card underwriting on their existing data, new purpose. Sending the pre-approved offer with their personal data attached, new purpose. Each one needs a consent basis that names the credit card as the product. The personal loan consent does not cover any of this. They're already our customer is not a defense the DPB will accept. Internal cross-sell is operationally easy, but under DPDPA, it is its own consent event. So what does fresh consent actually look like? Bad version 1. Implicit. Customer didn't unsubscribe from our marketing email, so we assumed consent. That is not consent. Silence is not affirmative action. Bad version 2. Pre-ticked checkbox. The default on consent box sitting on a notification screen. Even worse, sometimes hidden behind by tapping continue, you agree to. DPDPA explicitly requires clear affirmative action. Pre-ticked is the opposite of affirmative. Good version? Explicit. The customer sees a clear screen that says, to check your eligibility for a credit card, we will pull a fresh bureau report and assess your data. They actively click yes.
The consent screen is separate from the offer screen, no bundling. And the moment they click yes, your system captures a consent artifact. Customer ID, product, credit card, timestamp, channel, notice version, affirmative, specific, documented. That's the standard. I want to leave you with a practical exercise you can run in your own business this week. Pull a list of customers who either have more than one product with you or who received a cross sell offer in the last 6 months. For each one, look at your consent records. Do you have a separate product specific consent for each product they have? Or do you have one onboarding consent that you've been stretching to cover everything? Most lenders fail this audit on the first run. They find one consent record per customer instead of one per product. That gap, multiplied across your customer base, is your DPDPA exposure. And the good news is, you have time. The operative obligations come into force in May 2027. You have 18 months from notification to fix this. But the work is real, and the longer you wait, the more painful the cleanup. In the next lesson, we look at the second dimension of consent that lenders consistently get wrong: channel. In the last lesson, we covered product wise consent. One customer with 3 products needs 3 consent records. Now we add the second dimension: channel. If the same customer applies for the same product through 2 different channels, your app and your DSA, those are still 2 separate consent events, with 2 separate consent artifacts, with 2 separate notice versions. This catches lenders out because operationally, channels feel interchangeable. The customer ended up applying. The data ended up in your LOS. Why does the path matter? Let me explain why it matters under DPDPA. Why does channel matter? 3 reasons. First, different notice content. The privacy notice on your app is rarely identical to the script your DSA reads from at a customer's home. Your branch poster says one thing, your website privacy page says another. Even when teams try to keep them consistent, version drift happens. So when a customer agreed, they agreed to a specific version of a specific notice on a specific channel. Second, different consent UI. On the app, consent is a tap. With a DSA, it might be a signature on paper or on a tablet. At a branch, it's a form. Each one creates a different type of evidence. If the consent is ever challenged, you need to produce the specific proof that matches the channel. Third, different revocation paths. We'll talk about revocation in detail in Module 3. But under DPDPA, the customer must be able to revoke consent through the same channel they used to give it. If they consented through the app, they must have an in-app revocation mechanism. Each channel is its own track, with its own notice, its own consent capture, its own revocation route. Let me list out the channels a typical lending business runs: your direct app, your website, LSP and partner platforms, where the customer onboards on a partner's branded app, DSAs and agents, paper or digital, branch walk-ins, telecalling teams, and increasingly WhatsApp and chatbots. Each one of these is a separate consent track. Each needs its own consent flow design. Each needs its own audit. And here's the operational reality I see. Most lenders have built consent on their primary channel really well, usually the app, and then the other channels are an afterthought. The DSAs are using a 6-month-old notice. The branch posters haven't been updated. The chatbot doesn't capture consent at all. Each gap on each channel is a separate exposure. Now let me introduce the operational mechanism that makes all of this work. The unique consent ID. Every time a customer consents to anything, your system must generate a unique traceable record, a unique consent ID, and that ID must carry 6 pieces of information: the data principal identifier, your customer ID, the product, personal loan or credit card or home loan, the channel, app, DSA, branch, LSP, the notice version. And yes, you need to version your notice and store every version, the timestamp, exact date and time, and the lawful basis claimed, usually consent, but sometimes legitimate use. Why all 6? Because if a customer ever disputes consent, I never agreed to this, your defense is to produce this artifact. The unique consent ID is your evidence. Without it, a dispute becomes a one against one argument. With it, you have a documented record that names exactly what they agreed to, when, where, and how. Let me call out the specific channel level pitfalls I see in lending today. LSP channel. The customer is onboarding on the partner's app. They see the partner's logo, the partner's screen, the partner's terms, and somewhere in there, the consent screen for your underwriting. The mistake is letting the partner's branding dominate. The consent must clearly identify you as the lender, not the LSP, because the LSP is not the fiduciary. You are. We'll go deeper on this in Module 3. DSA channel. The classic problem: paper forms with notice versions from a year ago still being used.
Customer signs. The DSA never reads the notice out loud. The notice is on the back of the form in 6-point text in English when the customer reads only Hindi. None of that creates valid consent. Telecalling channel, verbal consent captured on a recording. Recording quality is bad. The customer says Hanji or yes sir, and the agent reads a 30-second script that summarizes nothing. That's not informed consent. Branch channel, sales staff verbally describing the scope differently from what the printed notice says. Posters not updated. Customers signing under social pressure rather than informed agreement. Each channel has its own version of these problems. Each one needs its own fix.
So, how do you know your channel wise consent is in good shape? Run a simple two-part test. Test 1. Pick a random customer from each channel, one from app, one from DSA, one from branch, one from LSP. Can you produce the exact notice version that customer saw at the moment of consent? If your notice has been updated 3 times in the last year, can you show which of the 3 versions applied to them? Test 2. Can you trace the consent path? From the moment the customer entered that channel, opened the app, started the form, picked up the DSA's tablet, to the moment consent was captured, with timestamps in between. So you can show the customer saw the notice before they consented, not after. If you can produce both for every channel, your channel wise consent is in good shape. If you can't, that channel needs work. And work on that channel comes before any other DPDPA build, because consent is the foundation everything else sits on. In the next lesson, we look at a distinction that determines which consents need to be louder than others: universal consent versus explicit consent, and where the line is drawn for a lending business.
This is one of the most practical distinctions in DPDPA for a lender, and it's one of the least understood. Not every consent needs to be a standalone, in your face screen. Some consents are routine, therefore, things the customer obviously expects you to do because they applied for a loan. Other consents are non routine, for things the customer would not expect unless you specifically called it out. DPDPA doesn't use these exact terms, but the operational distinction lenders use is universal consent versus explicit consent. Universal consent covers the things that come with the package. Explicit consent covers everything else. Let me draw the line. Let's start with universal consent. What does it cover? It covers the standard processing that any reasonable customer would expect when they apply for a loan. Verifying KYC documents internally, calculating an internal credit score, storing the loan application in your LOS, communicating with the customer about their own loan, processing the disbursal and the EMIs, sending the NOCs and statements after closure. These are the things a customer obviously expects to happen because they walked into a loan application. They are core to the lending purpose itself. These can be captured in your onboarding consent, bundled together. The customer doesn't need a separate screen for each one. But, and this is important, your notice must still clearly describe each one. Bundling does not mean hiding. Now, explicit consent. The simplest test I use is, if the customer would be surprised to learn you did it, you needed explicit consent for it. In a lending business, here are the things that always need explicit consent. Bureau pulls. And not just bureau pulls in general, each agency separately. CIBIL is one consent, Experian is another, CRIF is another, Highmark is another. Why? Because each agency is a different third party processing their data. The customer must know specifically which agencies you'll pull from. Sharing with co-lending partners. The customer must know and explicitly agree that another lender will see their data. Cross-sell to insurance, investment, mutual fund partners. These are completely separate purposes from the loan. They need their own consent. Sharing with non-regulated third parties. Anyone outside the RBI regulated ecosystem. Digital data providers. Perfios, FinBox. Even though they are providing routine analytics, they are third parties processing the customer's bank statements and KYC documents. Each needs explicit naming, account aggregator data fetch. Even though AA itself is a consent-based architecture, your use of the data fetch through AA needs to be specifically named, and marketing communications outside the loan itself. Promotional offers, newsletters, cross-product pitches. The customer didn't sign up for marketing when they applied for a loan. All of these explicit, standalone, named. If you remember nothing else from this lesson, remember this test. For every data action your system performs, ask one question. If the customer found out we did this, would they be surprised? If yes, they would be surprised. You needed explicit consent. Surprise is the signal. If no, it's something they obviously expected. Universal consent likely covers it. And when in doubt, default to explicit. The cost of an extra consent screen is small. The cost of a regulator finding that you processed without consent is large. Now, let me get specific about how to bundle universal consent properly. On your onboarding screen, a single consent button is fine for the universal scope. The customer doesn't need 10 checkboxes for 10 routine processing activities. But the notice that supports that single button that must clearly list everything: what data you collect, why you collect each data point, who you share it with, every name spelled out, how long you keep it, how the customer can revoke or correct it, and who to contact for grievances. And the notice must be available in English plus the 22 official languages recognized under the Constitution. DPDPA explicitly requires this. So if your customer is in Tamil Nadu and reads only Tamil, your notice must be available in Tamil. And it has to be clear, plain, and scannable. Not a 40-page terms and conditions document buried under 6-point text. The DPB will judge whether the notice was actually informative or just a defensive wall of text. Now I know what some of you are thinking. If every explicit consent is a separate standalone screen, the onboarding flow becomes a nightmare. The customer abandons after the third pop-up. Fair concern. Let me show you the way around it. The bad version. Every explicit item gets its own full screen pop-up with a single checkbox. Customer abandons. The good version. Group your explicit consents into sections, but keep each item within the section as a separate toggle. Section 1. Bureau pulls. Bill has its own checkbox. Experian has its own. CRIF Highmark has its own. Customer can see all of them at once and tick each individually. Section 2. Third-party data tools. Perfios, FinBox, each named, each with its own toggle. Section 3. Marketing and cross-sell. Visibly separate, clearly marked optional. The customer can tick none of these and still get their loan. This satisfies DPDPA's specificity requirement. Each entity is named, each consent is granular, without forcing the customer through 15 separate screens. And critically, your loan approval is not conditional on the optional consents. That's another DPDPA requirement we'll come to. Last point on this lesson, and it's an important one. DPDPA says consent must be unconditional, not just specific. Unconditional. That means you cannot condition the loan approval on consents for things that are not necessary for the loan itself. So, tying loan approval to bureau pull consent, that's allowed. You genuinely cannot underwrite without a bureau report. The bureau pull is necessary for the loan purpose, but be loan approved only if you also tick the insurance cross-sell box. That is not allowed. Insurance cross-sell is not necessary for the loan. Tying one to the other makes the consent for the cross-sell conditional. And conditional consent is not valid consent. Same logic for marketing. Tick this marketing box to proceed with the credit card. Not allowed. Marketing has nothing to do with the credit card decision. Optional consent must remain optional. The loan must approve regardless of whether the customer ticked the optional boxes. This is the rule that's most violated in current practice. And it's a rule the DPB will look at carefully when they audit. In the next lesson, we apply all of this to one of the most consent-heavy areas in lending: bureau pulls across the entire loan lifecycle. Bureau pulls are probably the single most consent-heavy data action in your lending business. You pull bureau data multiple times across a single loan's life: pre-sanction, post-sanction monitoring, again at collections, and possibly again for cross-sell. Each one of those pulls is a separate processing event. Each one needs a consent basis. And the question DPDPA asks is each pull covered by a consent that is still valid for that specific purpose? Most lenders have one consent at onboarding and assume it covers all the pulls forever. That's not how DPDPA reads it. Let me walk through the life cycle.
Pre-sanction pull. The customer applied for a loan, you need to underwrite, so you pull a bureau report. This is the easiest consent case. The rule is simple. Consent must exist before the pull happens, not after, not implied, not assumed because they walked into the application. And the consent must name each bureau: CIBIL, Experian, CRIF, Highmark, and state the purpose, which is to assess the loan application. Practical operational tip: your system should log the consent timestamp before the pull timestamp. If your data flow ever shows a bureau pull happening at 10:03 am and the consent timestamp is 10:04 am, you have a problem. The order matters and the order must be auditable.
Post-sanction monitoring pull. The customer has the loan, they're paying EMIs. You pull bureau every month or every quarter to monitor their credit profile. This is where things get tricky. Two questions you must be able to answer. First, is this monitoring pull covered in the original consent the customer gave at loan application? It is only covered if your notice and consent screen specifically mentioned ongoing monitoring during the loan tenure. If your notice said to assess your loan application, that covers the pre-sanction pull. It does not cover monthly monitoring. Second, even if your notice mentioned monitoring, is the consent still valid? Consent under DPDPA is not perpetual. It has a validity period. We'll cover validity and reconsent in detail in Module 3. But the principle is, don't assume your loan application consent extends to monitoring forever. Most lenders today have a gap here. Their consent language covers the application time pull but is silent on monitoring. Then they pull bureau every month and assume they're covered. They're not. Collection stage pull. Customer has fallen into delinquency. Your collections team wants to pull a fresh bureau report to see the customer's current credit position before deciding on the recovery approach. Critical point. The purpose has changed. The original purpose was to assess a loan application. The current purpose is collections decision making. Different purpose, different processing, needs its own basis. Two ways to handle this properly. Option 1. At origination, your notice and consent explicitly name collections related processing as one of the purposes. So if recovery becomes necessary, you pull bureau under that name purpose. This is the cleanest path. Option 2. You rely on legitimate use. The argument here is that you have an existing legal obligation, a contractual right to recover the loan, and bureau data is necessary for that. Legitimate use is a valid basis under DPDPA, but it's a narrow carve-out. You need to document the basis carefully. What you cannot do, pull bureau at the collection stage with no documented basis and figure it out later. That's a violation that can stack across every collections case. Quick clarification because this comes up a lot. In the bureau industry, there's a distinction between hard pulls and soft pulls. A hard pull shows up on the customer's credit report and can lower their score temporarily. A soft pull is invisible to other lenders and doesn't affect the score. Some lenders ask, does DPDPA treat them differently? Is a soft pull less of a consent issue? DPDPA's answer is no. Both are processing of personal data. Both need a consent basis. The customer's data is leaving your system either way. Soft versus hard is a bureau industry distinction, not a DPDPA distinction. That said, your notice should distinguish between the two, because the customer is entitled to know whether the pull affects their score. If you do a soft pull on a marketing eligibility check and it doesn't affect their score, tell them that. If you do a hard pull at loan application and it does, tell them that. Misleading the customer on this, implying a hard pull is a soft pull when it isn't, is an informed consent failure. It's not the soft pull versus hard pull that's the problem. It's misrepresenting it. Here's the practical exercise to do with your team. Open your LOS, list every trigger that initiates a bureau pull. Loan application is 1. Monthly monitoring is 1. EMI bounce alert is 1. Pre-approved offer eligibility is 1. Collections decision is 1. Cross-sell qualifying is 1. For each one, document 5 things. The stage of the life cycle. The bureau being pulled, whether it's a hard pull or a soft pull. The lawful basis you're claiming, consent or legitimate use, and specifically where in your notice this purpose is described. Any row where you can't fill all 5, that's a gap. That's a bureau pull happening without a documented lawful basis. This single exercise will surface most of your bureau-related compliance gaps. And once you have the matrix, you have your remediation list. In the last lesson of this module, we look at the privacy notice itself and why it has to name every party explicitly with no shortcuts. This is the last lesson of Module 2, and it's the one that fixes the most common notice failure I see. Most lending privacy notices today contain language like, we may share your data with our partners, vendors, service providers, and other third parties as necessary for the purposes described. That language was acceptable in the pre-DPDPA world. It is not acceptable now. Generic language does not satisfy the specificity requirement of DPDPA. Your privacy notice and terms of use must name every party, specifically, by name, with no shortcuts. Let me walk you through who must be named, what the language should look like, and how to handle changes over time. Let me give you the full list of who must be named. Every credit bureau you use, not just credit bureaus, the actual names, CIBIL, Experian, CRIF, Equifax, whichever ones you actually pull from. Every co-lending partner, named. If you co-lend with 3 NBFCs, all 3 are listed. Every insurance and cross-sell partner, named. The HDFC, Life or Bajaj Allianz or whoever. Every collection and recovery agency, named, including third-party recovery firms. Every legal counsel firm that handles your recoveries or disputes. Every third-party data tool, Perfios, FinBox, and whatever else you use. CKYC registry, Aadhaar eKYC providers, GST providers, account aggregator network entities, and every LSP and sourcing platform you work with. This list will be longer than you think. The first time you do this exercise, expect to find vendors that have access to customer data but aren't in your current notice.
That's normal. Fix it. Why does generic language fail under DPDPA? Let me show you with 3 examples. Example 1, we may share your data with our partners. This fails because the customer cannot identify who the partners are. They have no way to evaluate whether they're comfortable with the sharing. That fails the informed test in DPDPA's consent definition. Example 2, we may share with service providers as necessary. The phrase as necessary is not specific. Necessary for what? Loan processing, marketing, cross sell, different answers, different consents needed. Fails the specific test. Example 3. We may share with our affiliates and group companies. This is a sneaky one. Each group company is a separate fiduciary under DPDPA. The customer must specifically know which group companies will get their data and what each one will do with it. Generic affiliate language hides what is actually a separate data flow to a separate entity. All of these are failures, easily fixable, but they need active rewriting. DPDPA Rules 2025, specifically Rule 3 and Schedule 1, spell out what your notice must contain. Let me walk through it. An itemized list of every type of personal data you collect. Not a category, the actual items. Name, phone, email, PAN, Aadhaar, bank statements, bureau pulls, each one listed. The specified purpose for each item. Why are you collecting Aadhaar? For eKYC. Why are you collecting bank statements? For underwriting. Each item has its purpose, the goods, services, or use that the data enables. So the customer understands what they get in return for sharing the data, how to give consent, and equally importantly, how to withdraw it, how to exercise their rights, access, correction, erasure, grievance redressal, and how to complain to the Data Protection Board if they're not satisfied with how you handle their grievance. All of this in plain, accessible language and available on demand in English plus the 22 official languages recognized in the 8th schedule of the Constitution. Here's a question I get asked all the time. What happens when we add a new partner mid-year? Do we need to reconsent every existing customer? The answer depends on 2 questions. First, will existing customers' data actually flow to this new partner? If you're adding a new partner only for new customers going forward, existing customers' data is unaffected. No reconsent needed for them. Second, if existing customers' data will flow to the new partner, is that flow covered by their existing consent? In almost all cases, no, because their existing consent named the partners that existed at the time of consent, not future partners. So if existing customer data is going to flow to a new partner, you need reconsent. The process. Update your privacy notice and publish the new version. Notify existing customers, usually through a reconsent screen on their next app login or website visit. New customers from the date of the new notice see the updated version automatically. Yes, this is operationally heavy. That's why most lenders try to bundle notice updates, adding multiple partners at once rather than every 2 months. But the principle is firm. New partner whose name isn't in the consent, reconsent required. One last point on notice. Language. DPDPA requires that the notice be available in English plus 22 official languages recognized under the Constitution. For lending, practically, you should at minimum cover the top 5 languages your customer base reads. Your app, your website, your DSA scripts, your branch posters, all should detect language preference and serve the appropriate version of the notice. And if you use machine translation, and many lenders do for cost reasons, get the output reviewed by a native speaker. Generative AI translations are good, but not perfect. A bad translation that misrepresents what the customer is consenting to is itself an informed consent failure. Here's the principle. If your customer reads only Tamil and your notice is in English, they cannot give informed consent. The notice exists, but it's not informing them. That's a failure. Let me recap Module 2 because we covered a lot. Product-wise consent. Every product is its own consent event. Cross-sell needs fresh consent. They're already our customer is not a defense. Channel-wise consent. Every channel, app, website, DSA, branch, LSP, telecalling is its own consent track with its own notice version, its own consent capture, and its own revocation route. Universal versus explicit consent. Universal covers what the customer obviously expects. Explicit covers what would surprise them. When in doubt, explicit. Bureau pulls. Every pull across the loan lifecycle, pre-sanction, monitoring, collections, cross-sell needs to be mapped to a documented lawful basis. Notice names every party. Plain language available in English plus 22 languages. Updated when partners change. Consent in lending is operationally complex. The build is real, but it is finite. Walk through it section by section and it gets done.
That's Module 2. Consent is the foundation. If you get this right, everything else becomes easier. If you get this wrong, no amount of other compliance work can fully compensate for it. Take a moment and, if needed, go back and rewatch lesson 3. In module 3, we move into the challenge specific to modern lending. What happens when you don't directly face a customer? When a LSP, co-lender, DSA, or partner platform sits in between. Consent in that world comes with its own rules. So see you there. Welcome to Module 3. Most lending today does not happen face to face. It happens through someone else's app, LSP, DSA, partner platform, or a co-lender. And very often, the customer never sees the lender. They see the partner. And that intermediation creates a real DPDPA challenge. Who actually collects the consent? In whose name? What happens when two lenders co-lend the same loan? What happens when a customer wants to revoke a consent through a different channel? And how long should a consent last on something like a 5-year home loan? This module answers all of that. 5 lessons focused on real-world scenarios most lenders deal with every day. So let's get into it.
Let me describe a flow that almost every modern lender will recognize. A customer wants a personal loan. They open the LSPs app. Let's say it's a Fintech aggregator. They download it from the Play Store. They fill in their details on the LSP's screens. They tap to consent on the LSP's consent screen. They read the LSP's terms and conditions. They submit. Behind the scenes, the application gets routed to you, the NBFC. You underwrite, you approve, you disburse. The customer gets the loan. From the customer's perspective, they took a loan from the LSP. They never saw your branding. They never saw your terms. They may not even know your name. DPDPA view of this, you are still the fiduciary. Every obligation lands on you, and the consent that was collected by the LSP must satisfy DPDPA in your name for your products on your behalf. This is the most common compliance blind spot in modern lending. Let me unpack it. Why are you still the fiduciary? Recall the test from Module 0. The fiduciary is whoever decides why personal data is collected and how it is used. In the LSP arrangement, who actually decides any of this? Who designed the loan product? You. Who set the underwriting rules that determine which fields are required on the form? You. Who decided what data inputs are needed for risk assessment? You. Who makes the final approve or reject decision? You. The LSP isn't designing any of this. They're executing your design. They're a processor working under your specifications. You are the fiduciary. And once you accept that, the consequences flow naturally. The consent must be in your name. The notice must describe your processing. The grievance contact must be yours. Because every customer interaction is ultimately an interaction with you. Let me get specific. What does consent in your name actually look like on a screen? The LSP can have their own branding. They can run the rest of the experience. But on the consent screen, the customer must see you, the actual lender, clearly identified. So the screen says you are applying for a loan from, and then your name, not buried in fine print, not on a separate disclosures page, up front where the customer reads it. Then it says, by tapping consent, you authorize, and again your name, to do the following. And it lists the actions. Pull your bureau report, verify your KYC, access your bank statements through FinBox or Perfios, share data with the co-lender. Each action named, each third party named. The LSP's logo can be there, the LSP's brand colors can be there. But on the consent screen, you, the lender, are visibly and unambiguously identified. If the customer cannot tell you are the lender from the consent screen alone, you have failed the informed consent test. Let me call out the 3 specific failures I see in LSP flows today. Failure 1. Hidden lender. The consent screen is fully LSP branded. The lender's name appears only on the disclosures page that nobody reads. The customer taps consent without knowing who the lender even is. Failure 2. Generic lender pool. The LSP says, your application may be matched with one of our lending partners without telling the customer which one. So the customer is consenting to data sharing with an unspecified entity. That fails the specificity test we covered in Module 2. Failure 3. And this is the worst one. The LSP's T&C is substituted for the lender's notice. The customer reads the LSP's privacy policy, which describes the LSP's processing. But the LSP's policy doesn't describe what the lender will do with the data. Bureau pulls, underwriting, sharing with collections agencies, all of that. The customer never sees the lender's notice at all. All 3 of these are common. All 3 are violations, and all 3 need fixing on every LSP integration you have. Now let me address a sharper version of this problem. Multi-lender LSP. Here's the flow. The LSP collects the customer's data, runs a quick eligibility check, and routes the application to one of several lender partners based on who's most likely to approve. This creates a real DPDPA challenge. At the moment the customer consents, they don't know which lender will end up getting their data.
One of our partners is exactly the generic language that fails the specificity and informed tests. Two ways to handle this properly. Option 1. At consent time, disclose the full pool of possible lenders by name. Your application may be assessed by lender A, lender B, or lender C, depending on eligibility. Customer consents to data sharing with the entire pool. This works only if the pool is finite, named, and disclosed upfront. Option 2. Two-stage consent. First consent is for pre-screening. Let the LSP run an initial eligibility check across the pool. Once a specific lender is matched, you go back to the customer with a named consent. Your application has been matched to lender name. Please confirm you consent to data sharing with this specific lender. Option 2 is cleaner from a DPDPA standpoint because each consent is specific to a named entity. Option 1 is operationally simpler but only works if you can genuinely list every possible lender in advance and the pool doesn't change.
Practical exercise. For every LSP you work with, and you should have a list, go through the actual customer journey. Get screenshots. Don't trust the LSP's verbal description. See what the customer actually sees. Then check 5 things on each consent screen. Is your name visible above the consent button, not just on the disclosures page? Is the consent worded in your name, not the LSP's? Are all the third parties, every bureau, every analytics tool, the co-lender, if there is one, named on the screen? Is the lawful basis documented? Is your notice, your actual notice as the lender, accessible from this consent screen, not just the LSP's privacy policy? In my experience, most lenders fail multiple checks on most LSPs the first time they run this audit. The LSP integrations were built years before DPDPA, and nobody has gone back to fix them. That's the gap. And closing it is operationally heavy. It requires renegotiating with every LSP and changing their UI on your behalf. But it has to be done, which brings us to the next lesson. What your agreements with the LSP actually need to contain to make all of this real.
If you're a lender working with LSPs, your existing LSP agreements are almost certainly out of date for DPDPA. Most LSP agreements were drafted in a pre-DPDPA world. They cover commercial terms, the fee structure, the targets, the exclusivity. They cover RBI's outsourcing obligations to some degree. Some of them mention data security in vague language, but they don't contain the specific clauses DPDPA expects from a processor agreement. And you're going to need to add those clauses by amendment, addendum, or full renegotiation to every existing LSP relationship and every future one. In this lesson, I'll walk you through the 6 clauses every DPDPA compliant LSP agreement must contain. Clause 1. Data processing obligations. This clause defines what the LSP can and crucially cannot do with customer data. The LSP can only use customer data for the purposes you specify. The purposes flow from your processing, sourcing, KYC verification, document upload, status communication. That's their scope. What the LSP cannot do, they cannot use your customers' data for their own purposes. No marketing the LSP's own products to your customers using data they collected on your behalf. No selling the data. No aggregating it for the LSP's analytics or business intelligence. The principle from DPDPA is the processor processes only on documented instructions from the fiduciary. You give the instructions, they execute. They don't have an independent right to use the data they hold for you. This clause closes off a real loophole many LSPs operate under today, using your customer data for their own funnel optimization or product cross-sell. Clause 2. Consent collection standards. This is where you spell out exactly how the LSP must collect consent. Because remember, they are collecting it on your behalf, in your name. They have to do it your way. Spell out which version of your notice they must display. You control the notice. They don't draft their own version of it. Spell out the consent UI requirements. No pre-tick boxes. Clear affirmative action. Separate toggles for explicit consents. The patterns we covered in Module 2, make them contractual. Spell out the languages. If your customer base needs Hindi or Telugu, the LSP must support all of them on their flow. Spell out the consent artifact format. The 6 fields we covered in Module 2, data principal ID, product channel, notice version, timestamp, lawful basis, must be captured by the LSP and delivered to you in real time. Why real time? Because the moment a customer disputes consent, you must be able to produce the artifact. If it's sitting on the LSP server and you have to email them to retrieve it, you've already lost time. Clause 3. Audit rights. This is the clause that lets you verify the LSP is actually doing what they promised. Without this, the contract is words on paper. Your audit rights should include the right to inspect the LSP systems and consent capture flows, the right to sample check actual consent artifacts to make sure they meet your specifications, the right to demand evidence of staff training,
the right to commission independent third-party audits if you suspect non-compliance. And one more, the LSP must cooperate with regulator audits initiated against you. If the DPB walks into your office and asks for evidence of LSP channel consent, the LSP must produce it, not after a 30-day legal review, promptly. And here's the operational truth most lenders miss. Audit rights are useless if you don't exercise them. Put a quarterly cadence on the calendar. Sample 10 consent artifacts from each LSP every quarter. Walk through their flow. Check the notice version they're serving. Audit rights are only as strong as the audits you actually run. Clause 4. Breach notification. This clause is operationally critical. If the LSP suffers a breach involving your customers, you need to know fast. Because your DPDPA breach notification clock, the 72 hours to notify the Data Protection Board, starts the moment any party in your data chain becomes aware. Your contract must specify a hard notification window. Within 24 hours of the LSP's awareness, they notify you. That gives you 48 hours to investigate, draft notifications, and meet the 72-hour deadline. The initial notice should describe the scope, how many customers, which data categories, when the breach occurred. The detailed root cause report comes within 72 hours. The LSP must cooperate with whatever the DPB asks of you, and there must be specific liability for the LSP if their delay causes you to miss your own notification deadlines. Here's the principle. The LSP's awareness becomes your awareness. If they know on Monday and tell you on Thursday, your clock retroactively started on Monday. That's why the 24-hour push is non-negotiable. Clause 5. Data return and deletion at termination. This is the clause that's missing in almost every LSP agreement I've reviewed. It addresses a basic question. When the relationship ends, what happens to the customer data the LSP holds? Without an explicit clause, the answer in practice is the data sits on the LSP's servers indefinitely. Long after they stop sourcing for you, they still have customer records they accessed during the relationship. The contract must specify 3 things. 1. The LSP returns all customer data to you in an agreed format, usually within 30 days of termination. 2. The LSP deletes all copies, production data, backup tapes, log files, archives, everything, and gives you written certification of deletion, signed by their compliance officer. 3. The only carve-out is data the LSP is required by regulation to retain. Not data they want to retain, not data they think might be useful, only data they're legally required to retain. And only that data. Without this clause, terminated LSPs continue to hold customer data forever, and any breach on their side, even years later, becomes your problem. Clause 6. Indemnity. Here's the situation. The LSP causes a DPDPA violation. Bad consent capture, mishandled customer data, unauthorized processing. The DPB investigates. The penalty falls on you because you're the fiduciary. RBI doesn't transfer liability. DPDPA doesn't transfer liability. But your contract can between you and the LSP. The indemnity clause is what protects you financially. It says, if a penalty is imposed on us due to your non-compliance, you indemnify us for the penalty. You indemnify us for the legal costs of defending against complaints traceable to your conduct. You indemnify us for any customer compensation we have to pay arising from breaches on your side. There will be reasonable caps and exceptions. Your legal team will negotiate those. But the principle is firm. Liability to the regulator stays with you because that's what DPDPA mandates. But financially, between the two parties, you should be able to recover the costs caused by LSP failures. Most existing LSP agreements have weak indemnities or none at all. This is the highest leverage commercial fix in the entire DPDPA renegotiation. Let me give you the practical path forward because this is real work. Step 1. Inventory. List every LSP, every DSA, every partner with access to customer data. This is the same list we built in Module 1, Lesson 4, but applied specifically to data-touching partnerships. Step 2. Pull every existing agreement. Map the gaps against the 6 clauses we just covered. Step 3. Draft a single DPDPA addendum that addresses all the common gaps. Don't reinvent for each partner. One template. Step 4. Push the addendum to every partner with a clear deadline. Make it easy to sign, but firm on the timeline. Step 5. Some partners will push back, some will refuse. For those, you have a decision. Either rework the commercial terms to make the addendum acceptable or terminate the relationship. There's no middle ground. Target every active partner under DPDPA compliant terms before May 2027. That's 18 months from when the rules were notified. And it sounds like a long time, but the negotiation cycles eat it fast. Next lesson, what happens when there's another lender in the mix? Co-lending.
Co-lending is its own animal under DPDPA, different from LSPs, different from DSAs. So I want to spend a full lesson on it. Here's the basic setup. Two regulated lenders co-fund a single loan. Customer takes one loan, but behind it, two NBFCs share the funding, typically 80 to 20, between the originating lender and the funding partner. Under DPDPA, the question is, who's the fiduciary? And the answer is both of them. Each lender is a fiduciary for their portion of the loan. Neither is the other's processor. They are peer fiduciaries, each independently accountable to the customer and to the regulator. That status creates real consequences. Let me walk through them. Why are both lenders fiduciaries and not, say, the originating lender as the fiduciary and the funding lender as a processor? Apply the DPDPA test. Who decides why and how data is processed? In a co-lending arrangement, both lenders make their own decisions. The originating lender does its own underwriting on its portion of the risk. The funding lender does its own underwriting on its portion. Both retain genuine risk on their balance sheets. Both report to credit bureaus independently. Both have customer-facing obligations under RBI rules, Fair Practices Code, KFS, and so on. Both are deciding. Both are fiduciaries, which means the data sharing between them is sharing between two independent fiduciaries, not sharing from a fiduciary to a processor. That's a fundamentally different DPDPA relationship, and it has different requirements. Here's the practical implication. When you share customer data with the co-lender, that's a data flow to a third-party fiduciary. Under DPDPA, that requires explicit, specific consent. So three things must be true. One, the co-lender is named in your privacy notice. Specifically named, our co-lending partner, XYZ NBFC, not our co-lending partners generically. 2. Explicit consent at onboarding that names the co-lender. The customer ticks a box that specifically references data sharing with the named co-lender. 3. The customer is informed about what data flows to the co-lender and why. Their bank statements, KYC, repayment history, each named in the consent. And here's a corollary. If you bring on a new co-lender mid-relationship, for existing customers, you need reconsent. Or you keep the new co-lender restricted to new customers only. Existing customers' data cannot retroactively flow to a co-lender they never agreed to. Now let me get into a problem co-lending creates that almost no one has thought through. DSAR coordination. DSAR, Data Subject Access Request. The customer comes back and says, show me everything you have on me, or delete what you have on me. Under co-lending, the same customer's data is sitting with both lenders. Both received it, both processed it, both are obligated to respond. If the customer files an access request, both must produce their portion. If they file a deletion request, each lender independently decides what they can delete based on their own retention rules. And then both have to coordinate so the customer doesn't get two different timelines or two different answers about what's been deleted. Without explicit coordination, this becomes a mess. Customer files request with you. You respond. Customer files same request with co-lender. Co-lender responds differently. Customer goes to the DPB alleging inconsistency. The co-lending agreement must specify who handles which DSAR scenario. There should be a single customer-facing point of contact for any data right exercise. That point of contact then internally coordinates with the other fiduciary. The customer experiences one cohesive response, not two parallel proceedings.
Same logic for breaches. Imagine the co-lender's database gets breached. Your shared customers are affected, meaning customers whose data sits with both you and the co-lender. You are still a fiduciary for those customers, so your DPDPA obligations apply, even though the breach happened on someone else's infrastructure. Your 72-hour DPB notification clock starts when you become aware. Your obligation to notify the customer applies, and your liability for your portion of the data continues. This is why your co-lending agreement must include mutual breach notification. Within 24 hours of either party becoming aware of a breach, they notify the other. The DPB notifications get coordinated, so both lenders file consistent reports. The customer notification, same message, sent jointly or in close coordination, so the customer doesn't receive contradictory communications. And cooperation on root cause investigation, so both regulators get the same story. Without this, a breach on one side becomes a chaotic, multi-front crisis on both sides.
Let me close this lesson with what the actual co-lending consent disclosure should say, because most lenders today have nothing close to this. On the customer's consent screen at origination, they should see something like, this loan is co-funded by, naming both lenders. By providing consent, you authorize data sharing between the two lenders for the following purposes, and then list the actual purposes: underwriting and approval decisions, disbursal coordination, repayment tracking, collections, bureau reporting. And importantly, each lender reports separately to bureaus, so the customer should know that statutory and regulatory reporting. And then each lender is independently responsible for protecting your data. Specific. The lenders are named, the purposes are listed, mutual responsibility is acknowledged. This is what specific informed consent looks like in a co-lending context. Now, next lesson, we move from how consent is collected to how it gets revoked. Because consent that can't be withdrawn isn't really consent under DPDPA. DPDPA has a principle that's often overlooked but operationally significant. Withdrawal of consent must be as easy as giving it. Most lenders have spent enormous effort designing the consent collection flow. Beautiful UI on the app, clear screens, multilingual support. And then, when the customer wants to withdraw, they have to email a generic help desk and wait for a response. That's a violation. Withdrawal must be as easy as giving consent. If giving consent took 2 taps in the app, withdrawing must also take 2 taps in the app. If consent was given through the LSP, revocation must be available through that same path. In this lesson, we walk through what that means operationally and what has to happen downstream when a customer revokes. Let me list the channels and what revocation must look like on each. App. If consent was given on your app, revocation must be available in the same app. Usually a privacy settings or consent center page where the customer can see all the consents they've given and toggle them off. Website. Same principle. If consent was given on your website, the website must have a revocation flow. IVR or call onboarding. If consent was captured over a call, the customer should be able to revoke through a call. Or, and this is acceptable, the call confirmation should clearly tell the customer how to revoke through your app or website with simple instructions. Email or WhatsApp consent. Whatever channel was used to capture consent should also be the channel for revocation. DSA or branch, paper consent. Written revocation must be accepted. The customer can write a letter, hand it to the branch, or send it by email. You cannot demand they come back to the branch in person and redo paperwork. LSP. The LSP must offer revocation through their platform. That's part of the agreement we covered in lesson 2. Or if not, you must offer the customer a clear alternative path on your own systems. And on top of all of these channel-specific routes, there must be one master route the customer can always use: your DPO's public contact and grievance email. So even if the channel-specific revocation is broken or unavailable, the customer has somewhere to go. Now here's the part most lenders haven't built: the downstream cascade when consent is revoked. Revocation isn't a single CRM update. It's an event that has to propagate across every system and partner that was relying on that consent. Inside your systems, your CRM has to flag the customer's revoked status in real time. Your LOS has to block any further processing that depended on the revoked consent. Your marketing automation has to suppress the customer from new campaigns. Your bureau monitoring has to stop the recurring pulls if those were under the revoked consent. Your cross-sell engine has to exclude the customer from eligibility. Outside your systems, your LSPs and partners have to receive the revocation signal through an API or scheduled batch and update their own records. Your co-lender, if relevant, must be informed. Your insurance and cross-sell partners must stop their processing. This cascade has to be reliable, fast, and auditable. Because the day a customer revokes consent and you continue processing, even by mistake, you have a violation, and the regulator will not accept the partner system hadn't updated yet as a defense. You're the fiduciary. Coordinating the cascade is your responsibility.
How fast does the revocation cascade need to happen?
DPDPA's
Its principle is without undue delay. The rules don't give a hard number, but the industry expectation is forming around a tight timeline. Internal systems updated within 24 hours. Partner systems propagated within 72 hours. Customer confirmation, letting them know revocation is processed within 7 days. And here's why speed matters. Every hour between revocation and cessation of processing is an hour you're processing without consent. If your CRM stops marketing the customer immediately, but your bureau monitoring keeps pulling for 2 weeks because that system wasn't on the revocation cascade, those 2 weeks of pulls are unauthorized processing. And the customer must receive a confirmation that tells them 3 things. Their revocation has been received, specifically which processing has stopped, bureau pulls, marketing, cross-sell, and what processing will continue, and why. For example, you may continue to retain loan records under regulatory mandate. Tell them that with the basis. Honest, specific confirmation, not a generic thank you for your request auto reply. One scenario worth covering specifically: partial revocation. The customer says, "Stop sending me marketing, but I still want my loan to keep running. I'm not asking you to delete my account." This is partial revocation, and DPDPA supports it because consent, as we discussed in Module 2, is granular. Each purpose has its own consent. The customer can revoke any one of them without affecting the others. So, in this scenario, the marketing consent is revoked, marketing stops. The loan processing consent continues, the loan runs as normal. The bureau monitoring continues if it was disclosed and is necessary for the loan. The cross sell consent is revoked, no offers go out. Each consent lives independently. Your system has to support this, not a binary on off for the customer relationship, granular control of which purposes are active. The lenders who try to make this binary, if you revoke any consent, you have to close the loan, are violating the unconditional consent principle. The customer cannot be forced to close their loan as the price of revoking marketing consent. Practical tips for building the revocation architecture. First, centralize the revocation event. Don't have 10 different systems each implementing their own revocation listening. Have one master service that captures every revocation, and every other system, internal and partner, subscribes to that service. Webhooks, event streams, whatever your architecture supports. Second, every consent has a clear owner system. Marketing consent is owned by the marketing platform. Bureau monitoring consent is owned by the LOS. When a revocation comes in, you know which systems must act. Third, audit log. Every revocation logged. When received, when propagated, to which systems, with timestamps. So if a regulator ever asks, "How fast did you act on this revocation?" you can answer. Fourth, give the customer a dashboard. My consents. They see all the consents they've given. They can toggle each one. They see the status: active, revoked, pending propagation. This isn't just compliance, it's good product. It builds trust. And fifth, test routinely. Quarterly drill. Pick a customer. Simulate a revocation. Time how long the cascade takes. Find the bottlenecks. Fix them. Compliance built and never tested doesn't actually work. Last lesson of this module: consent doesn't just live and die, it also expires. Let's talk about validity. Last lesson of Module 3, and it's the one that surprises lenders the most. Consent under DPDPA is not perpetual. It has a validity period. After that period, or after specific trigger events, the consent expires and you need to either get fresh consent or stop processing. This matters for lending because loans are not short engagements. A home loan is 20 years. A personal loan is 3 to 5 years. Even a credit card relationship can last decades. Consent given at the start of that relationship doesn't automatically remain valid through the entire arc. Let me walk through how to think about validity, expiry, and reconsent across the lending lifecycle. How long is consent valid? DPDPA doesn't fix a single duration. The principle is consent is valid for the purpose it was given for while that purpose continues. Once the purpose ends, the consent has done its job and it should expire. Let me translate that into lending. Loan processing consent. The consent that authorizes you to process the customer's data for their loan is valid for the duration of the loan, plus a reasonable post-closure window for finalization work, typically 90 to 180 days after the loan closes, to handle NOC issuance, final settlement, and any cleanup. After that window, this specific consent has run its course. Bureau monitoring consent for the recurring pulls during the loan tenure is valid only while the loan is active. Once the loan closes, monitoring should stop. The consent for ongoing monitoring is no longer valid. Marketing consent should typically be reviewed annually. The customer should be reminded what they're consented to and given the opportunity to refresh or revoke. Cross-sell consent, valid for the duration of the relationship, but I'd argue should be specifically reaffirmed before each cross-sell event. The customer agreed to cross-sell 2 years ago. Confirming they still want offers before you push the next one is good practice. The principle: set explicit validity periods. Document them in your notice. Don't leave them implicit. Now, even within a consent's normal validity period, certain trigger events require fresh consent. Let me list them. 1. Adding a new product. Customer has a personal loan with you. You want to add a credit card. We covered this in Module 2. That's a new product requiring fresh consent. 2. Adding a new third-party partner. You signed up a new insurance partner mid-year. Existing customers' data will now flow to that partner. Reconsent required from existing customers, or restrict the new partner to new customers only. 3. Bureau pull after the original consent's validity has lapsed. This is more nuanced. If your monitoring consent was valid for 12 months and you continue pulling in month 14, that's processing without valid consent. 4. Significant change in how data is used. You start using customer behavioral data for AI-driven cross-sell when you didn't before. Material change of purpose. Reconsent required. 5. Material notice updates. You update the notice in a way that materially changes what processing happens. Existing customers must see and accept the new version. And here's a piece of practical advice. Reconsent is friction. Plan it into your customer journey. Don't surprise the customer with a reconsent screen they weren't expecting. Tell them in advance, explain why, and make it easy to act on. Now, let me come to the conversation that scares lenders the most. What happens after the loan closes? Customer comes to you and says, "Loan is closed, delete my data." DPDPA says, "Delete when purpose is served." So, loan closure should trigger deletion. RBI says, "Retain loan records for the prescribed periods." Typically 8 to 10 years depending on the loan type and the regulation. Income tax says, "Retain financial records for 8 years." PMLA says, "Retain KYC records for 5 years post-closure." Many lenders see these as in conflict and freeze. They are not in conflict. They reconcile cleanly if you bucket your data correctly. Bucket 1, data that regulation explicitly mandates you to retain. Loan records as RBI defines them. KYC records as PMLA defines them. Financial records as income tax defines them. You retain this data under the legitimate use basis in DPDPA. The customer's deletion request does not apply to this bucket, and you tell them so with the regulatory citation. Bucket 2, everything else: marketing data, behavioral data from your app, third-party enrichment from FinBox or Perfios that wasn't part of the regulatory record, cross-sell propensity scores. None of this is mandated to be retained, so all of this gets deleted on the customer's request. 2 buckets, different rules, both sit alongside each other. No conflict, just careful classification. And one more piece, the purge log. Every deletion event must be documented, not just the deletion itself, the documentation of the deletion. Capture the customer ID and the reference for the request, the date the request was received, the date deletion was completed, the categories of data that were deleted, the categories of data that were retained with the specific regulatory basis cited for each, the systems where the deletion was performed, and the confirmation that was sent to the customer. Why does this matter? 2 reasons. 1. If a regulator ever questions the deletion, you said you deleted, but we found this customer's data on a vendor system. Your log shows what you deleted, what you retained with basis, and that vendor data either should have been part of the deletion or was legitimately retained. 2. If a customer ever returns, you promised to delete my data, but I'm still getting your marketing emails. Your log shows the deletion was performed, and either there's been a system error you can fix immediately, or the marketing was through a separate consent that wasn't covered by the deletion request. The purge log is your defense. Build it into the deletion process from day 1. Module 3 recap. Even when you don't face the customer directly, you are the fiduciary. Consent must be in your name. Notice must describe your processing. Grievance contact must be yours. LSP agreements need 6 specific clauses: data processing limits, consent collection standards, audit rights, breach notification, data return at termination, and indemnity. Most existing agreements lack most of these. Co-lending. Both lenders are fiduciaries, each independently accountable. Coordinate on consent disclosure, DSAR responses, and breach communication. Revocation must be as easy as consent, and it has to cascade across your systems, across LSPs, across partners, with audit-grade tracking. Consent is not perpetual. Plan for validity, expiry, and reconsent, including the post-closure conversation about retention and deletion. Module 4 takes everything we've covered conceptually so far and turns it into practical implementation. Data maps, DPIAs, vendor management, breach playbooks, the systems behind compliance. That's Module 3. If Module 0 to Module 2 explain what the law says, Module 3 explain what the law looks like inside a messy reality of modern lending. LSP renegotiations, co-lender disclosures, revocation cascades, post-closure deletion logs. None of this is glamorous, but this is the real work. In Module 4, we now build the systems behind it. Data flow mapping, DPIAs, vendor management, breach response playbooks. The operation layer that makes the compliance actually work. So see you there. Welcome to Module 4. Until now, this course has mostly been about understanding the law, the rights, consent rules, the LSP ecosystem. All important, all necessary. But this module is different.
This module is about execution. What you actually do on a Monday morning when you sit down to build a DPDPA compliant lending business. 5 lessons, 5 practical disciplines. Data flow mapping. Your foundation document. Data protection impact assessment. The framework you use before launching anything new. Vendor management, turning processor agreements into actual governance. Breach response playbook, what you prepare before something goes wrong, not after. And finally, how all this comes together into a compliance program that actually runs. This is where DPDPA stops feeling like a regulation and starts becoming a way of operating. Let's get into it.
In Module 1, Lesson 4, we said the data flow map was the foundation of your entire DPDPA program. In this lesson, we actually build it. Most lending businesses don't have a real data flow map. They have pieces. The product team has the customer journey. The tech team has the database schema. The compliance team has the regulatory data list. None of these is the data flow map. The data flow map is the consolidated view. What data, where it enters, how it moves, where it ends up, who touches it along the way. Let me walk you through how to build one. A complete data flow map has 4 dimensions. What, where, who, why, what. Every personal data element you process. Name, phone, email, PAN, Aadhaar, bank statements, bureau pulls, location, device ID, behavioral data. Plus the sensitive personal data subset. Financial data, health, biometrics. Where every system that holds each piece of data. Your LOS, your CRM, your data warehouse, your backup systems, your partner systems, your vendor systems, the cloud regions, who, every party with access, your internal teams, sales, ops, underwriting, collections, your vendors, your partners, your regulators when they request data. Why? The purpose for each flow. Underwriting, KYC, statutory reporting, ongoing servicing, marketing, cross-sell. If your map answers what, where, who, and why for every data element, you have what you need to make every other DPDPA decision. Step 1. Inventory every data element. Walk every customer journey, onboarding through every channel, underwriting and approval, disbursal, servicing, EMIs, statements, queries, cross-sell and marketing, collections and recovery, loan closure and what happens after. For every screen the customer sees, every API call your system makes, every form a DSA fills, list the personal data being captured. Be granular. KYC isn't a data element. PAN, Aadhaar, address proof, photograph, signature. Those are data elements. And remember from Module 0, personal data is broader than you think. Location at app install, device ID, IP address, time on screen, click patterns, all of it. The output of this step is a single sheet, a complete data inventory. Every personal data element you collect or generate listed once. Step 2. Map each element to its purpose and lawful basis. This is where most teams find the first big surprise. They start asking, why are we collecting this? And realize the answer is fuzzy. For each data element, document 3 things. Why it is collected, the specific purpose, not a vague category. The lawful basis, consent, legitimate use, or regulatory mandate. And where in your privacy notice this purpose is described. Be honest with yourself. If the answer to why are we collecting this is we've always collected this, that's not a purpose. That's an inheritance. And under DPDPA, inheritance is not a lawful basis. If you cannot articulate a clear purpose for a data element, you have a choice. Either define the purpose properly and update your notice or stop collecting it. Many lenders, the first time they do this, find 5 to 10 data elements they collect with no clear purpose. Cleaning that up is real DPDPA progress. Step 3. Map where each element lives. This is the step that makes most teams uncomfortable because they realize the same data element is sitting in many more places than they thought. For each data element, list every system holding it. Your production database, your read replicas and analytics warehouse. Most lenders forget the warehouse on the first pass. Backup systems and archives, including offline tape backups if you have them. Log files and monitoring tools. Yes, customer data leaks into logs unless you actively scrub it. Vendor systems, your LSP holds it, your KYC vendor holds it, your bureau partner has it, Karza or Perfios hold it. Partner systems, your co-lender holds it, your insurance partner holds it, your collections agency holds it. And customer-facing artifacts, the app shows it, your statements show it, your emails contain it. Most lenders are surprised at how many systems a single piece of customer data actually lives in. The first time you do this, expect to find data in 10 or 15 places when you thought it was in 3. Step 4. Map access and movement. For each system on your map, document who has access. internal teams, roles, and individual users for high privilege systems. Document inbound flows, how data gets into this system, from where. Document outbound flows, where data goes from this system to where. Document the retention policy for this system, how long data lives here. And document the deletion mechanism, how data is actually removed when it should be. This is where your map becomes a diagram. Boxes for systems, arrows for flows, ownership labels on each box, color coding for sensitive data versus regular personal data. Once you have this diagram, you can answer questions you couldn't answer before. If a customer asks for deletion, what systems do we need to clean? If a breach happens in our LOS, what data was potentially exposed? If we add a new partner, where in this diagram do they fit? The diagram becomes your operational reference. Print it, put it on the wall, update it every quarter. Step 5. Make it living, not static. The single biggest failure I see with data flow maps is someone builds a beautiful map, presents it to the board, and then forgets it. 6 months later, the business has launched 2 new products and onboarded 3 new partners. The map is fiction. So define the triggers that update the map. New product, new partner, new vendor, new data element, system architecture change, vendor termination. Each of these requires a map update, not at the next quarterly review, immediately, and then a regular cadence on top, minimum quarterly review. Even when nothing has changed, walk through it once a quarter. Catch the things that did change but weren't flagged. Owner of the map, the DPO. They drive the review, they coordinate the updates, they get sign off from product, tech, and legal. The map is one of the DPO's most important artifacts. Let me close this lesson by reminding you what your data flow map unlocks. Your privacy notice. You write it from the map. Every system, every partner, every flow becomes a line in the notice. Your consent flows, designed from the map. Every entry point, every onward flow gets a consent screen. Your vendor renegotiation list comes straight from the map. Every processor on the map needs a DPDPA compliant agreement. DPIA scope, defined by the map. The next lesson covers DPIAs, DSAR fulfillment. When a customer asks for their data, you search every system on the map. Without the map, you don't know what to search. Breach response. When something goes wrong, you know exactly which systems and partners to call. The map is your incident playbook input. Retention policy, set per system on the map. Each system has its own retention rule. Without the map, every other compliance task is harder. With the map, they become checklists. That's why the map is the foundation. Data Protection Impact Assessment, DPIA. Module 1 mentioned this is one of the 3 SDF obligations. In this lesson, we cover what a DPIA actually is, when to do one, and how to make it useful instead of theater. First, what is a DPIA? It's a structured review you do before launching anything that involves personal data. New product, new partner, new system, new processing purpose. The review asks, what are the privacy risks and how are we going to manage them? If you're an SDF, DPIAs are mandatory. If you're not classified yet, they're best practice. And as we said in Module 1, build as if you will be classified, which means start doing DPIAs now. When do you do a DPIA? In a lending business, here are the specific triggers. Launching a new lending product, personal loan, credit card, gold loan, vehicle loan. Each new product is a new processing purpose. Onboarding a new LSP or DSA, a new data flow path with a new partner. Adding a new third-party data tool, a new processor in your data flow. Starting a co-lending arrangement, sharing data with another fiduciary, introducing a new analytics or AI ML use case on customer data. This is increasingly common, using transaction data to predict default, using behavioral data for product recommendations. Each such use case has privacy implications worth assessing. Major changes to your underwriting or scoring models, especially when they introduce new data inputs. Cross-border data transfer to a new vendor or region. Sending customer data outside India or to a new country. New marketing or cross-sell channel. Rule of thumb, any change that touches your data flow map should trigger a DPIA. If the map changes, the privacy posture is changing, and a DPIA is how you assess whether the change is safe. What does a DPIA actually contain? 4 sections. Section 1. Description of the processing. What's being launched or changed. The personal data involved. The purposes. The lawful basis you're claiming. Section 2. Data flow. Where does the data come from? Where will it be stored? Who will access it? Where will it go? This is essentially a delta against your existing data flow map. Section 3. Risk assessment. This is the heart of the DPIA. Identify the privacy risks. For each risk, assess likelihood and impact. and specify the mitigating controls. What you're doing to bring the risk down to acceptable. Section 4. Decision and sign off. Approval, conditional approval, or rejection. Named owners for each control, dates, and a review schedule. When will this DPIA be revisited? 4 sections, not a 100-page document, 5 to 10 pages of focused analysis. Done well, this becomes a useful working artifact. Done badly, it's bureaucratic theatre. Let me walk through a real example so this becomes concrete. The trigger: your business wants to launch a credit card cross sell to existing personal loan customers using an ML model on their behavioral and transaction data to predict propensity. You run a DPIA. Here's what comes out: risks identified. The original personal loan consent doesn't cover credit card cross sell. That needs reconsent. The ML model uses behavioral data that wasn't disclosed in the original notice. That's a notice update. The pre-approval pulls bureau data without specific credit card consent. Another consent gap. And the customer may receive unwanted communications without an easy way to opt out. Revocation path needed. For each risk, you specify mitigating controls before launch. Update the notice to disclose ML-based cross-sell. Push a reconsent screen to existing customers on their next app login. Configure soft pull only at the eligibility stage, with hard pull happening only after explicit consent. Add a cross-sell revocation toggle in the privacy settings page. DPIA outcome: conditional approval. The launch can proceed, but only after all 4 controls are live and tested. That's a useful DPIA. It identified real gaps. It defined real fixes. And it didn't block the business. It shaped how the business launches. Who owns the DPIA? 4 roles. The sponsor, the business owner of the change, the product manager launching the new product, the risk head changing the underwriting model, whoever is driving the initiative. The drafter, typically the DPO or someone in the privacy office. They lead the DPIA process and write the document. The contributors: tech, security, legal, compliance. Each adds their lens. Tech describes the data flows. Security assesses controls. Legal validates the lawful basis. Compliance checks alignment with other regulations. The approver, the DPO, with escalation to the board for high-risk DPIAs. And here's the most important part: the DPO must have actual authority to block a launch. Not just to comment, not just to recommend, to block. If the DPO can't say no, the DPIA becomes a rubber stamp theatre. The business approves itself. Build the authority into the DPO role from day one. The board should explicitly grant the DPO the authority to refuse approval for any change that creates unacceptable privacy risk, with escalation only to the board itself, not to the line business. Last point on DPIAs: how to make them useful instead of theatre. Done early, before code is written, not after launch when it's too late to change anything. Many businesses pretend to do DPIAs. At the end, that's just signing off on what already happened. Real DPIAs happen at the design stage. Done lightly, 5 to 10 pages, not 50. The longer the document, the less anyone reads it. Focus on the real risks and the real controls. Skip the boilerplate. Done with risk owners, not just the compliance team writing in isolation. The product manager, the tech lead, the security lead. They have to be in the room. They own the controls. They need to commit to them. Done iteratively. The first DPIA at design. A revisit during build when scope shifts. A final check before go live. Privacy isn't a one-shot decision, done with real follow-up. Every control identified gets tracked to closure. We agreed to add a revocation toggle, verified that it's actually in the build before launch. Without follow-up, DPIA controls become wishlist items that never ship. DPIA done well, risk goes down and the launch happens on schedule. DPIA done badly, risk hides in the corner and the launch happens anyway. Module 3 covered the 6 clauses that should be in your LSP agreements. Data processing limits, consent collection, audit rights, breach notification, data return at termination, indemnity. Signing the contract is the easy part. Vendor management is what happens after the contract is signed. Are they actually doing what the contract says? Are you verifying? Do you have a process? This lesson is about turning your stack of vendor agreements into a real governance program. Step 1. Build a single vendor register. One sheet. Every vendor with access to customer data. Pulled from your data flow map. Same list, same scope. For each vendor, capture 8 things. Name and whether they have a DPDPA compliant agreement signed yet. Data categories they access. Volume of customer records they hold. Sensitivity tier, high, medium, or low, based on the type of data they touch. Last security review date. Last DPDPA specific audit date.
renewal date for the contract, and the owner inside your organization, the named person responsible for managing this vendor relationship. If you can't list every vendor on this single sheet, you can't manage them. The register is the operational backbone of vendor management. Step 2. Tier your vendors by risk. Not all vendors deserve the same level of oversight. Tiering helps you spend your governance budget where it matters most. Tier 1, critical. High volume of customer data, often sensitive data. Your LOS, your CRM, your KYC vendor, your bureau partners, your primary LSPs. These are the vendors where a breach affects most or all of your customer base. Quarterly DPDPA audits, annual deep reviews, active relationship management. Tier 2, significant, moderate volume or sensitivity. Perfios, FinBox, secondary LSPs, collection agencies handling subsets of your portfolio. Half yearly DPDPA audits. Tier 3, routine, limited data exposure. SMS or WhatsApp providers, IVR vendors, document management systems, annual audits. Don't apply Tier 1 oversight to Tier 3 vendors. That's wasted effort. Don't apply Tier 3 oversight to Tier 1 vendors. That's where breaches happen and you miss them. Tiering makes the work proportionate. Step 3. Define an onboarding gate. This is critical. The single fastest way new compliance gaps creep in is business teams onboard new vendors without involving compliance. The vendor goes live, customer data starts flowing, and only later does someone realize no agreement was signed, no security review was done, no DPDPA assessment happened. Fix this with a hard gate. No new vendor gets customer data access until they pass the gate. The onboarding checklist. DPDPA compliant processor agreement signed. Security questionnaire completed and reviewed. Encryption and access controls verified at a technical level. Breach notification process tested. Yes, do a tabletop drill before go live. Data deletion mechanism documented. What happens to data when this vendor relationship ends? Tier assigned and audit cadence set. Internal owner named. All checked. Vendor goes live. Anything missing? Vendor waits. No exceptions for the launch is urgent. Compliance gates exist precisely because launches are always urgent.
Step 4. Run the audits you promised. Audit rights in the contract are completely useless if you never exercise them. And many lenders never do. They have the right, they don't use it. The vendor knows they don't use it. 6 things to audit on each cycle. Sample consent artifacts. Pull 20, verify format and content. Are they capturing all 6 fields? Is the timestamp right? Is the notice version current? Walkthrough of the vendor's customer flow. What does the customer actually see at the consent screen? Get screenshots. Compare against what was agreed. Access controls. Who can see customer data inside the vendor? Is access role-based? Are there shared logins? Is there an audit trail of access? Data retention. What's actually being retained at the vendor versus what should be? Old data hanging around past retention is a breach risk. Subprocessors. Has the vendor added any subprocessors without telling you? This is a common silent shift. Your vendor outsources to someone you don't know about. Breach incidents. Any incidents in the period? Reported correctly? Within timelines? Document findings. Track remediation. Don't let issues drift. An audit that finds problems but doesn't close them is worse than no audit. Because now you knew about the problem. Step 5. Plan for vendor exit. Every vendor relationship ends eventually. The question is whether you're ready when it does. Termination triggers vary. Strategy change. You're moving away from this vendor for business reasons. Failed audit, repeated non-compliance you can no longer accept. Breach on the vendor side. They had an incident that disqualifies them. Better commercial alternative. A competitor offers better service or pricing. Whatever the trigger, exit must produce 4 things. All customer data returned in an agreed format, usually within 30 days of termination. Written deletion certification from the vendor, signed, dated, specific. System access cutoff, AP is revoked, accounts disabled, network paths closed, customer-facing implications managed. If your customers will notice the change, they need to be told what's happening and what's not changing. Vendor exit playbook, written, tested, ready before you need it. The day you need it, you don't want to be writing the procedure. Breach response is the highest stakes part of DPDPA in operational terms. Get it wrong, and a single incident becomes 3 regulatory violations and a public mess. And here's the truth. If you wait for a breach to figure out the response, you've already lost. By the time the incident happens, the clock is running. 6 hours for certain, 72 hours for the DPB, without delay to the customer. You don't have time to build a process during the incident. So this lesson is about building the playbook before you need it. 3 clocks run in parallel when a breach happens. You need to know all three by heart. Certain within 6 hours. This is your existing obligation under the IT Act and the certain rules. All cyber incidents involving lending businesses fall under this. 6 hours from awareness, DPDPA, customer notification, without delay. The rules notified in November 2025, specifically Rule 7, say without delay. Operationally, that means within hours, not days. The notification must include a description of the breach, the likely consequences for the customer, what you've done to mitigate, what the customer can do to protect themselves, and a contact for queries. DPDPA, DPB notification. Two-step, an initial notice without delay, a detailed report within 72 hours. And here's the critical thing about all three clocks. They start when any party in your data chain becomes aware, not when you become aware. If your LSP knows on Monday and tells you on Thursday, the clocks retroactively started on Monday. That's why your LSP agreement, Module 3, Lesson 2, has the 24-hour vendor notification clause to protect your clocks. 6 phases of breach response. Walk through each one before you need it. Phase 1. Detection. How does your team know a breach is happening in the first place? Monitoring tools, anomaly detection, customer complaints, vendor notifications, external researchers. Each of these is a possible detection path. Make sure each one has a clear escalation route into your incident response. Phase 2. Triage. Is this a personal data breach or just a security incident? Some incidents don't involve personal data. Quickly determine what data is affected, how many customers, what categories, is sensitive personal data involved. Phase 3. Containment. Stop the bleed. Cut off the attacker's access. Isolate the affected systems. Disable compromised credentials. Containment buys you time for the rest of the response. Phase 4. Notification. Certain DPB, customers, partners, the board. Each in the correct sequence and within their respective timelines. We'll talk about the sequence in a moment. Phase 5. Remediation. Fix the root cause. Strengthen the controls that failed. This is where the long tail of work happens after the immediate crisis. Phase 6. Post-incident review. Document what happened. Learn. Update the playbook. The breach you handle today is the training material for the next one. Named roles for the war room. When a breach hits, you don't have time to figure out who's doing what. The roles must be assigned in advance. 7 roles. Incident commander. Overall response, decision making, internal coordination. Usually a senior compliance or risk leader. Tech lead, containment, system actions, root cause investigation. DPO, DPDPA notifications, customer facing communications, working with the DPB. Security lead, certain notification, forensics, evidence preservation. Legal, regulatory communications, partner notifications, document review. Communications, customer messaging, press, social media, internal employee communications. Business lead, operational decisions, partner relations, customer relationship management. Each role has a primary and a backup because breaches don't happen at a convenient time. Sunday at 2 a.m. is when your primary will be unreachable. Contact details, physical card, kept in secure but accessible places. Digital backup, updated quarterly. Because someone will leave the organization and you'll find out during an incident if you don't refresh. Pre-drafted notification templates. Have these ready before you need them. During an incident, with the clock running, drafting from scratch produces bad copy. Mistakes slip in. Tone is wrong. Compliance content is missing. Get the templates ready in calm, peaceful times. Templates you need. Certain notification. The 6-hour one. Format aligned to certain requirements. DPB initial notice. The without delay one. Brief. What happened, when, scope. DPB detailed report. The 72-hour one. Comprehensive. Full description, root cause, remediation, customer impact, customer notification, multiple variants. SMS for urgent broadcast. Email for detail. App push for in-product context. Each customer should receive the message through the channel they're most likely to see. Partner notification for LSPs, co-lenders, vendors who need to know. Internal employee notification. Your team needs to know what's happening, what to say, what not to say. Press and social media holding statement. Even if you're not making a public announcement, you need a position statement ready in case the news breaks. Board and promoter notification. Senior leadership needs to know quickly with the right level of detail. Templates have placeholder fields. Fill in the specifics during the incident. The structure is ready. The structure is the hardest part to get right. And the last piece, tabletop drills. A playbook on paper is not a playbook in practice. Until you've actually walked through it with your team, you don't know whether it works. You don't know whether the contact details are current, whether the templates make sense, whether your team can reach each other within 30 minutes on a Sunday. Run drills. Quarterly, a light drill, single scenario, an hour or two. Annually, a full drill, multi stakeholder, half a day, with as many of the named war room roles in the room as possible. Scenarios to run: LSP database breach affecting 50,000 customers. Test the partner notification path, the customer notification scale, and your ability to coordinate across two organizations. Insider threat: an employee exfiltrating customer data. Test internal investigation protocols and the legal/HR coordination. Bureau API misconfiguration: your system pulls bureau reports without proper consent for a window. Tests how you discover, contain, and remediate processing without consent incidents. Cloud storage misconfiguration: bank statements publicly accessible due to a setting error. Tests rapid containment and the customer notification at scale. Vendor subprocessor change without notification: your vendor outsourced to someone you didn't approve. Tests vendor governance and contract enforcement. After every drill, debrief: what worked, what didn't, update the playbook based on what you learned. Track the gaps until they're closed before the next drill. This is how the playbook stays alive. Last lesson of Module 4. So far, we've covered 4 practical disciplines: data flow mapping, DPIAs, vendor management, breach playbooks. Each one alone is useful, but each one alone is also incomplete. In this lesson, I want to bring them together into a single DPDPA program that runs day to day, quarter to quarter, year over year. Because the goal isn't to do one cycle of each discipline and check the box. The goal is to build a function that operates continuously. Here's how the program cycle should look. Daily activities: consent capture happening across all channels. DSAR intake: customer requests come in continuously. Incident monitoring: your security tools are watching. Monthly activities: review of DSARs fulfilled. Were timelines met? Were any disputed? Vendor incident reports: any near misses or low severity events. Privacy metrics dashboard: consents collected, revocations processed, DSARs fulfilled. Average response time, open issues. Quarterly activities: data flow map review. What's changed? What needs updating? Tier 1 vendor audits: your most critical partners. Privacy notice review: does it still match the data flow map? Breach drill: quarterly tabletop on a chosen scenario. Annually, full program audit. And if you're an SDF, this must be independent. All vendor reviews: every tier 2 and tier 3 vendor through the cycle at least once. DPIA backlog review: what DPIAs are open, which need to be revisited. And board level reporting: privacy as a board topic, not just a compliance team topic. Daily, monthly, quarterly, annually. Each layer feeds the next. Roles and ownership: 6 functions in the program, each with a clear ownership. DPO, program owner, owns the program as a whole, reports to the board on privacy posture quarterly, has the authority to block changes that create unacceptable risk. Privacy office, 1 to 3 people depending on scale, handles day-to-day operations. DSAR fulfillment, consent issue triage, vendor coordination. The operational backbone: tech and security, implementation, consent infrastructure, encryption, access controls, detection systems. They build what the privacy office runs. Legal, contracts, regulatory liaison, dispute resolution. The legal team owns vendor agreements, customer-facing legal terms, and any DPB or court interaction. Business and product, privacy by design, DPIA participation, customer experience around consent and rights. The teams launching things have to take ownership of the privacy posture of what they launch. Compliance and internal audit, independent verification, program effectiveness review. They check whether the program is actually working, distinct from running it. 6 functions. If anyone is missing, the program has a gap. Metrics that tell you the program is working. DSARs received versus fulfilled within timeline. Are you keeping up with customer requests? Trend matters more than absolute numbers. Consent capture coverage: what percentage of your customers have current, valid, product-specific consent? This is a foundational metric. Most lenders start below 50% when they first measure. Closing that gap is your roadmap. Notice version drift: when was each language version of your notice last updated? Stale notices are a violation. Vendor agreements, DPDPA compliant. Percentage of your total vendor list under DPDPA compliant agreements. Track this until it's 100%. Tier 1 vendor audit coverage: percentage of Tier 1 vendors audited in the current cycle. DPIA cycle time, from design start to DPIA approval. Long cycle times mean DPI. A's are slowing the business. You'll get pressure to skip them. Breach detection time, from the anomaly being created to it being confirmed as an incident. Faster detection means smaller breaches. Breach notification time, from incident confirmation to DPB initial notice. This is the metric that protects you under DPDPA. Customer grievances received versus resolved within timeline. Same logic as DSARs. If you can't measure it, you can't manage it. Build the metrics, show them to the board. Privacy is a quantitative discipline now, not just a qualitative one. If you are starting today, here's the 90-day build, days 1 to 30. Foundations. Appoint or empower the DPO. Give them real authority. Build the data flow map. This is the longest single task. Inventory all vendors and partners. Audit your current privacy notice and consent flows against DPDPA standards. Days 31 to 60. Core build. Update your privacy notice. Name every party. Roll out product-wise and channel-wise consent across your customer-facing flows. Push your DPDPA addendum to all Tier 1 and Tier 2 vendors. Stand up the DSAR fulfillment process, even if it's manual at first. Days 61 to 90. Operational. Build the breach response playbook with name roles and pre-drafted templates. Run your first tabletop drill, even a light one. Do your first DPIA on a current change in flight. Deliver your first board-level privacy report. By day 90, the program is running. It's not perfect. There are gaps, there's work in flight, but it's running. And from day 90, you refine over the next 12 to 15 months, bringing the gaps to closure before the May 2027 operative deadline. 90 days. That's how long the foundational build takes. The gap most lenders have today and where they need to be by May 2027. That gap closes if you start now. It does not close if you wait. Module 4 recap, data flow map, the foundation document. Built once, updated continuously, never stale. DPIAs, pre-launch discipline, done early, lightly, with real ownership. The DPO can block vendor management, single register, tiered governance, onboarding gate, real audits, exit playbooks, breach playbook, 3 parallel clocks, certain 6 hours, customer without delay, DPB 72 hours, 6 phases, named roles, pre-drafted templates, tested in tabletop drills, program cycle, daily, monthly, quarterly, annually, with metrics that the board can see. This is the work. There is no shortcut to having done it.
That's module 4. If you made this far, you now have, at least on paper, everything needed to build a DPDPA compliant lending business. But paper is not operation. The final module is about what happens when those operations get tested. When a customer requests their data, when they ask for deletion, or when something actually goes wrong. These are real world moments that expose every point inside the system you've built. See you in module 5. Welcome to module 5, the final module of this course. Everything we've covered so far has been about building the data flow map, consent architecture, privacy notice, vendor agreement, the breach playbook. But this module is about what happens when all of that gets tested. When a customer asks for their data, when they ask for correction, when they ask for deletion, or when breach actually happens, either on your side or through a partner. And finally, we close with a practical 30-day action plan, specific, prioritized, and designed specifically for lending business. So that you leave this course not just with the understanding, but with clear next move. So let's get into it.
Module 0 introduced the right to access. Now we walk through what actually happens when a customer exercises it. The customer comes to you and says, show me all the data you hold on me. This is a data subject access request, ADSAR. Sounds simple? It's not, especially in lending, where a single customer's data sits across your systems, your vendors, your partners, and across multiple stages of the loan lifecycle. Let me walk you through what's actually involved in fulfilling a single DSAR for a typical lending customer. First, what does all data include for a lending customer? Let me list it out because most teams underestimate the scope. Loan application data, everything they submitted, KYC documents, Aadhaar, PAN, photograph, signature, income documents, salary slips, bank statements, ITR if they uploaded one, bureau pull history, every pull you ever made from every agency with every result returned, eKYC data, biometric verification logs, including face match scores and fingerprint matches. Underwriting decisions, your internal credit scores, risk flags, manual exceptions, loan account records, disbursement details, EMI history, repayment patterns, communication logs, every call you made or received, every SMS, every email, every WhatsApp message, call recordings. Yes, those count too. In-app behavioral data, clicks, screen visits, location at app install, device IDs, third-party enrichment, every output you got from Perfios, FinBox, or any other tool, collections records, agent notes,
recovery actions, field visits, if any, 12 categories, often more, depending on your business. The customer is entitled to see all of it. And here's the hard part. Most lenders don't hold all this data in one system. Inside your organization, the data is spread across your LOS, your CRM, your loan management system, your data warehouse, your call recording platform, your app analytics tool. 6 to 10 internal systems easily. Outside your organization, your LSP holds the onboarding stage records. Each bureau holds your pull history. Your KYC vendor holds the eKYC logs. Perfios, FinBox each hold the enrichment outputs they generated. Your collections agency holds their internal notes. Your co-lender holds their portion of the loan records. All of this must be retrieved, consolidated, and presented to the customer in one response. This is precisely what the data flow map from Module 4 was for. Without that map, you don't know where to look. With the map, the DSAR becomes a checklist. Query each system, retrieve the data, package it.
How should you respond? Format: structured, readable, customer friendly. Not a raw database dump. The customer asks to see their data. They want to be able to actually read it. Categorize by data type. Cite sources where relevant. This data was collected from your bureau pull on this date. This came from your bank statement upload during onboarding. Time frame. DPDPA's language is reasonable time frame. The rules don't fix a hard number. Yet, the industry converging norm is 30 days from request. Beyond that, you're inviting a complaint. Acknowledge receipt within 48 hours. Just confirming you got the request, you're working on it, and you'll respond within 30 days. This single acknowledgement reduces escalation significantly. Channel: respond through the same channel they requested through or as they specified. And use secure delivery. Encrypted email, a secure customer portal, or an in-app download. Don't email a CSV with someone's bank statements unencrypted to a Gmail address.
And what about when you legitimately cannot produce something? Some data is genuinely outside your scope. Be honest about it, but be specific. Acceptable reasons to decline. Data is not in your custody and never was. Disclosure would compromise an active fraud investigation. Disclosure would reveal another individual's personal data. For example, a co-applicant or guarantor whose details you can't share without their consent. Data has been deleted under retention policy and the customer was previously notified. How to communicate the refusal? Specific, reasoned, with the legal or regulatory basis cited. We are unable to share the bureau pull from 2018 as bureau side records are retained for 7 years and have since been purged. That's specific. The customer can verify it. What you don't do, give a generic "we don't have it" without explanation. That looks like obstruction, and the DPB will read it as obstruction if a complaint comes in. Let me lay out the end-to-end DSAR process. Step 1. Request received. Logged in your DSAR tracker with a unique reference number. The customer should get this reference back so they can quote it later. Step 2. Identity verified. Critical step. You must confirm the person making the request is actually the data principal. Otherwise, you're handing over someone else's data to a fraudster. Use existing authentication. Login, OTP, or for higher risk requests, a video KYC. Step 3. Acknowledgement sent. Within 48 hours, we have your request, reference number, expected response by date. Step 4. Data retrieval triggered. Query every system and every partner on your map. This is where automation pays off. Manual retrieval doesn't scale. Step 5. Data consolidated. Categorized by type. Sourced, meaning every record carries a note about where it came from. Formatted in a customer-friendly structure. Step 6. Quality review. The DPO signs off before the response goes out. Mistakes at this stage are visible to regulators. Step 7. Secure delivery. Encrypted through the customer's preferred channel. Step 8. Confirmation and closure. Ask the customer if they got everything they needed. If they say something's missing, that opens a follow-up sub-request. Don't close the DSAR until they confirm satisfaction or 30 days have passed. Step 9. Audit log updated. Request, response, timing, all documented. So if a regulator ever questions how you handle DSARs, you have evidence. Each step has a named owner. Each step has a service level. 48 hours for acknowledgement, 30 days for full response. Build it once, run it for every request. Quality stays consistent. Right to correction, customer comes back and says, your records show my monthly income as 50,000 rupees. It's actually 75,000 rupees. Or, the address you have on file is from 2 years ago. Or, my employer name was filled in wrong during onboarding. Correction sounds simple. In a lending business, it's anything but, because correction isn't just a CRM update. The same data point may be sitting in 5 different systems, and it may have already been reported to bureaus, shared with co-lenders, and used in underwriting decisions. Let me walk through how correction actually works.
Step 1. Verify the correction is valid. The customer claims a data point is wrong. Before you change anything, you have to verify the change is genuine. Otherwise, you're just letting people rewrite their financial records. Verification depends on the data type. For an address change, get an updated proof of address. Recent utility bill, registered rent agreement, updated Aadhaar. For a phone or email change, OTP confirmation on the new contact. They have to prove they actually control the new contact. For an income change, updated salary slip or bank statement. Customers asking to revise their stated income mid-loan deserves extra scrutiny. That's a fraud adjacent request. For a name correction, official document showing the correct name. PAN, Aadhaar, marriage certificate. For a date of birth correction, birth certificate, Aadhaar or PAN. You can ask for proof. You should ask for proof. Just trust me is not a basis for changing data on a financial record. DPDPA gives the customer the right to request correction. It doesn't take away your obligation to verify accuracy. Step 2. The cascade update. This is where most lenders fail at correction. The customer's address gets updated in the CRM. 2 months later, they get a debt collection letter at the old address. Why? Because the collections agency was working off a stale snapshot. The correction has to cascade. Just like consent revocation in Module 3. Here's how the cascade flows. Source of truth system gets updated first. Typically, your LOS or CRM, downstream system sync, either real-time through APIs or on a scheduled job. Bureau reporting. The next monthly TUDF cycle includes the corrected record, ideally with a correction flag so the bureau knows it's an update, not new data. Co-lender, notification goes out, corrected record pushed. Same for the collections agency if the customer is in their pipeline. Vendor systems, only those that hold the corrected field need updating, and the customer should receive confirmation. Specific. We have updated your address in our LOS, CRM, and customer portal. Your bureau records will reflect the change in the next reporting cycle by this date. Your collections agency, if any, has been notified. Specific confirmation reduces follow-up complaints by 80%. Step 3. The bureau correction question. Because this is the part lenders most often forget. Bureau reporting is one way. You push records to the bureau every month. They store them. Lenders can pull the bureau's view of a customer, but updating the bureau's records requires a specific correction process. Yes, you can correct what you've already reported. Each bureau has its own correction protocol. Sibyl has a dispute resolution mechanism. Experian has theirs. CRIF Highmark has theirs. As a lender, you initiate the correction by filing it with the bureau through their lender portal or API. Timeline expectations. Within 7 days of receiving the customer's request, you should have filed the correction with the relevant bureau. The bureau acknowledges in 7 to 10 days. The customer's bureau report typically reflects the update within 30 days. Document every step. Bureau corrections are heavily audited, both by RBI and by the DPB. If it ever comes up, keep the audit trail, date of customer request, date of internal verification, date of bureau filing, bureau reference number, date of bureau acknowledgement, date of customer confirmation. This trail is what protects you if the customer comes back 6 months later saying you never made the correction.
Documenting the correction, the audit trail. Every correction event must be documented in your system. 8 things. The field corrected, exactly which data point. The before state, what the data was. The after state, what it is now. The source of correction, what proof document or OTP or video KYC was used to verify. Who made the change? User ID of the operator. Timestamp, systems propagated to, and when each propagation completed. Customer confirmation, sent and acknowledged. Why all 8? If a regulator audits, this trail is your defense. Show us how you handle correction requests. You produce the trail. Done. If a customer disputes, you changed my income figure without my permission. You produce the trail showing you only made the change after receiving their request and verification document. Done. If something genuinely went wrong, wrong field updated, wrong customer's record changed, the trail tells you exactly what happened so you can fix it cleanly. This is the same discipline as breach response or DSAR. Document everything as you do it, not after.
Right to erasure. The most feared customer right in lending. The customer comes back 6 months after closing their loan and says, "Delete my data, the relationship is over, I want to be removed." And the immediate panic in most lending teams is, but RBI requires us to retain loan records for years. Income tax requires us to keep financial records for 8 years. PMLA requires KYC retention for 5 years post-closure. We can't delete? And the answer is yes, you can. You delete what you can, you retain what you must, and you communicate the difference clearly to the customer. Let me walk through how this actually works. The two bucket mental model. This is the cleanest way to think about it. Bucket 1 must retain data that regulation explicitly mandates you to keep. Under DPDPA, this falls under legitimate use. You're processing it because the law requires you to. RBI requires loan records typically for 8 to 10 years post closure, depending on the loan type. Income tax requires financial records for 8 years. PMLA requires KYC records for 5 years post closure. FEMA applies if you're in cross border lending. And anything under litigation hold. Active disputes mean retention until the dispute is resolved. All of this stays with a documented basis. The customer's deletion request does not apply to this bucket, and you tell them so with the regulatory citation. Bucket 2 must delete data that has no regulatory retention requirement. The customer's right to erasure applies fully here. Marketing data, their preferences, the campaign history, behavioral data from your app, clicks, session times, in app analytics, third party enrichment, FinBox or Perfios outputs that weren't used in the loan record, cross sell propensity scores you generated, soft pull data that wasn't part of the loan record. All of this gets deleted. Two buckets, different rules. No conflict, just careful classification. How to actually run the deletion? Step 1. Verify identity, receive the deletion request formally, log it. Same as DSAR. Step 2. Determine retention status for each data category. Walk through the buckets. Loan record, retain. Marketing campaign history, delete. Bureau pull, retain. It's part of the loan record. Behavioral data from the app, delete. Each category gets its own bucket. Step 3. Issue deletion commands to every system holding bucket 2 data. The data flow map is what you walk through to ensure nothing is missed. Step 4. Verify deletion happened. This is the step most teams skip. Deletion in production isn't enough. Backups, replicas, archives, those also need to be addressed. Either deleted or scheduled for deletion in the next backup rotation, or marked as containing deleted data, which gets purged on a defined schedule. Step 5. Propagate to vendors and partners. Same cascade as consent revocation. Tell your LSP, your Perfios, delete this customer from your records, except where you have your own retention obligation. Step 6. Generate the purge log entry. Same 8 fields we covered in Module 3, Lesson 5. Step 7. Send customer confirmation. And this confirmation must be honest and specific. Tell them exactly what was deleted. Tell them what was retained, with the regulatory basis. Tell them how long the retained data will live and when it eventually gets deleted. Honesty here builds trust. Vague confirmation breeds complaints. Let me give you sample language for the customer confirmation. Because most lenders today either don't send this confirmation at all or send a generic auto reply that creates more confusion than clarity. Here's what good looks like. Following your deletion request received on this date, categories deleted from our systems include marketing communication preferences, in-app behavioral data, cross-sell propensity scoring, third-party enrichment data not part of the loan record. Categories retained as required by regulation include loan account record retained for 10 years post-closure under RBI rules, bureau pull history forming part of the loan record, KYC documents retained for 5 years post-closure under PMLA. Financial records retained for 8 years under the Income Tax Act. This data will be deleted upon expiry of the retention period above. You may request confirmation of deletion at that time. Specific, honest, cited. The customer knows exactly what's gone, what's staying, and why. And critically, the customer knows when the rest will be deleted and that they can come back later for that confirmation. This level of clarity makes the customer feel respected, and it's almost impossible to challenge in a regulatory complaint. And one more piece, the long tail deletion. Retention periods are long, 5, 8, 10 years. Most lenders today retain everything indefinitely, partly because their systems don't have proper retention metadata, partly because nobody has ever been forced to delete. That changes under DPDPA. Bucket 1 data must actually be deleted when its retention expires. We forgot isn't a defense. Holding data past its retention period is itself a violation. You no longer have a lawful basis for processing it. Build the long tail deletion into your data lifecycle. Each data category tagged with its retention rule and a calculated expiry date, based on closure date or transaction date. An automated job runs monthly or quarterly, identifies data past its retention date, queues it for deletion. A quarterly review by the DPO. Was anything missed? Are the retention rules right? An annual purge cycle. Comprehensive sweep of everything past its retention date. Don't keep what you don't need. The data you keep is data you have to protect. Smaller footprint, smaller risk.
Module 4, Lesson 4 covered breach response in theory, the 3 clocks, the 6 phases, the war room roles. This lesson walks through what happens when you actually use the playbook. Two scenarios. 1, a breach on your side. 2, a breach on your partner's side. Both have hit lenders before. Both will hit lenders again. And the response sequence is different for each.
Scenario 1. Breach on your side. The kinds of incidents I'm describing: your LOS database compromised by an external attacker, a misconfigured cloud storage bucket exposing bank statements publicly, an insider exfiltrating customer data over weeks, a lost laptop with customer records, a phishing attack leading to an admin account takeover. Let me walk you through hour by hour what should happen. T plus 0. Detection. Your monitoring fires an alarm. Your security team confirms it's not a false positive. Initial triage begins. T plus 1 hour, incident commander declares it an incident. The war room, virtual or physical, is convened. The 7 named roles from Module 4 are pulled in. T plus 2 hours, containment is in progress. Scope is being assessed. How many customers? What data? When did this start? T plus 4 hours, certain notification is drafted. Templates from your playbook are pulled, specifics are filled in. T plus 6 hours, certain notification is submitted. This is the hard deadline. You don't miss it. T plus 8 hours, initial DPB notification submitted. Brief, factual, what happened, scope, immediate actions. T plus 12 hours, customer notification begins. SMS, email, in-app, push to affected customers. T plus 24 hours, initial customer side communication is complete. Most affected customers have been notified through at least one channel. T plus 72 hours, detailed DPB report submitted. This is the comprehensive write-up. Root cause, timeline, customer impact, remediation underway, long-term controls being put in place. 3 hard deadlines: 6 hours, 24 hours, 72 hours. All running in parallel from T plus 0. The playbook from Module 4 is what makes this achievable. Scenario 2. Breach on your partner's side. This is the harder scenario operationally because someone else's failure becomes your DPDPA problem. Examples. Your collections agency has its database compromised, affecting customers in their pipeline who are your customers. Your LSP's app is breached, customer data leaked from their side. Your KYC vendor exposes document uploads on a misconfigured server. None of these happened on your infrastructure, but you are still the fiduciary. So the question is, what changes versus a breach on your own side? Your DPDPA notification clock? Same. It starts when you become aware, whether the breach happened on your side or the partner's side. Your certain obligations depends on your reporting standing. As the lender, you may or may not need to file with certain depending on the specifics, but the breach itself certainly requires certain reporting from someone in the chain. Your contract should clarify whose responsibility this is, with both parties cooperating. Your customer-facing obligations apply regardless. The customer is your customer. They get the notification from you, not from the partner. And the first thing you ask, when did the partner know? When did they tell you? If they told you within 24 hours of their awareness, your timeline is intact. If they delayed in telling you, your DPDPA clock retroactively started when they became aware. And you may already be late on your obligations through no fault of your own. That's where the indemnity clause from your LSP agreement matters. It's also why the 24-hour vendor notification clause we covered in Module 3 is non-negotiable.
Coordinated response with the partner. This is the operational discipline most lenders haven't practiced. Stand up a joint war room, your team and their team in the same call or the same room. Establish a single source of truth on facts. Both teams working from the same incident timeline, same scope assessment, same affected customer list. Even small inconsistencies look bad to regulators. Coordinated regulator filings. The DPB should see consistent statements from both fiduciaries. Same facts, same timeline, same customer impact numbers. Inconsistency between the two filings is a red flag the DPB will dig into. Coordinated customer communication. Same message, same time. The customer should not get one explanation from you and a different one from the partner the next day. Joint root cause investigation and joint remediation tracking. You're both on the hook. You're both rebuilding trust with regulators and customers. Cooperation is the only winning strategy. Disagree publicly and both of you lose. Disagree internally if you must. Resolve the commercial dispute over the indemnity later. Quietly, contractually. The breach response itself is not the time. After the storm, the post-incident review.
Within 7 days of containment, do an internal review. Honest, detailed, not a face saving exercise. What was the root cause? Don't accept a vulnerability was exploited as the answer. Why was the vulnerability there? Why hadn't it been patched? Whose responsibility was it? What controls failed? Encryption, access controls, logging, MFA, each one that could have prevented or limited the incident. What controls saved you? Equally important, the things that worked are the things you protect and strengthen. What did you miss in detection? How long was the breach happening before you noticed? Why wasn't it caught earlier? What did you miss in response? Were the war room roles clear? Did the templates work? Did you hit your deadlines? What do you need to fix? Output of this review. A remediation roadmap, specific controls being added or strengthened with owners and dates. An updated playbook. What you do differently next time. A board briefing. What happened? What we did? What's now different about how we operate? And know this, the DPB may follow up on a breach for months. They ask for evidence of remediation. They check whether your fix is actually shipped. Have all of this ready before they ask. Don't scramble for it weeks later. Final lesson of the course. And it's a practical one. By now, you have all the conceptual understanding and operational knowledge you need. But the gap between knowing and doing is real. Most teams leave a training course like this, go back to inboxes full of urgent things, and the DPDPA work slips. So, this lesson is the next 30 days. Specific, prioritized. For a lending business, built so that on day 31, you have measurable progress to show. 4 weeks, 4 focus areas. Let's walk through them. Week 1, audit and foundations. Objective is visibility. Where are you actually right now? Day 1, form a working group, DPO or interim owner. Tech lead, legal, product, 5 people max. This is the group that drives the next 30 days. Day 2 and 3, inventory data collection points. Every channel where customer data enters your system. App, web, DSA, LSP, branch, telecalling. List them. Get screenshots of the consent screens. Day 3 and 4. Map current consent capture against what DPDPA requires. Where are you collecting consent today? Is it product specific, channel specific? Are explicit consents standalone or buried? Use the framework from Module 2. Day 4 and 5. Vendor list. Every party with access to customer data. Pulled from your tech inventory, your contracts, your invoices. The list will be longer than you expect. Day 5. Initial gap report. Present to leadership. 1 page. Where you are versus where DPDPA expects you to be. Output by end of week 1. That 1 pager. Honest assessment. The starting point everyone aligns to. Week 2. Notice and consent architecture. Objective is fixing the customer facing layer. Day 6 to 8. Rewrite the privacy notice. Every party named. Plain language. Cover everything we discussed in Module 2 Lesson 5. This is doable in 2 to 3 days with a focused team. Day 8 and 9. Translate the notice into the top 3 to 5 languages your customers actually read. English, Hindi, plus your top regional languages. Day 9 and 10. Redesign the consent UI. Product-wise screens, channel-wise variations, granular explicit consent toggles. The patterns from Module 2. Day 10. Deploy the revised notice on your app and website. And let me set realistic expectations. The full consent rebuild across every channel, every flow, with the unique consent ID, with revocation paths, with vendor coordination, takes longer than a week, months, often. The goal in week 2 is to get the visible notice update live and lock down the design decisions for the consent rebuild that continues for several months. Don't try to ship everything in week 2. Ship what can be shipped. Plan what comes next. Week 3, vendor management. Objective is bringing vendor agreements up to standard. Day 11 and 12, pull all current vendor agreements. LSPs, KYC vendors, bureau partners, collections agencies, third-party tools. Every contract that touches customer data. Day 12 and 13, map gaps against the 6 DPDPA clauses we covered in Module 3, Lesson 2. Data processing limits, consent collection standards, audit rights, breach notification, data return at termination. Indemnity, most existing agreements are missing most of these. Day 13 and 14, draft a single DPDPA addendum template, one template that covers all 6 clauses. You don't reinvent for every vendor. Day 14 and 15, send the addendum to Tier 1 vendors first, your most critical partners, with a clear deadline for signing. By end of week 3, the top 5 to 10 critical vendors have received the addendum. The communication plan for Tier 2 and Tier 3 vendors is locked when each batch goes out, and the vendor register is live and being maintained. This isn't all of vendor management. that takes months to complete. But it's the start, and it's the most important start. Week 4. Operations and process. Objective is standing up the actual operating processes. Day 16 and 17. Build the initial DSAR fulfillment process. Manual is fine to start. The end-to-end 9-step process from lesson 1 today. Documented. Owners named. Day 18 and 19. Same for correction and erasure response processes. Day 20 and 21. Draft the initial breach response playbook. 3 clocks, 6 phases. Named roles. Pre-drafted templates. 8 templates from Module 4 Lesson 4. Day 22 and 23. Set up the consent revocation paths on the app and website. My consents page or equivalent. So the customer has a way to revoke. Day 24 and 25. Run your first tabletop drill. Light. One scenario. An hour or two with the war room team. Find the gaps. Day 26 to 28. Document everything you've built. Brief leadership on progress. Plan what comes after day 30. Day 29 and 30. Lock the quarterly cadence. Owners are named for everything. Metrics are defined and being measured. Day 30 outcome. Your operational rhythm is real, not theoretical. You have processes, owners, and a plan. From here, you refine. After day 30, the continuing work. LSP and partner consent screens. A full overhaul over 60 to 90 days. This is operationally heavy because it requires LSP cooperation, vendor addendum negotiations, months. Some partners will sign quickly, others will negotiate. A few will refuse, and you'll have a commercial decision to make. Full DPI, a process embedded in your product launch process, over 60 days. Every new product or change going through a DPIA before it launches. Comprehensive breach playbook, refined after every drill. The first version is day 30. The version that holds up under regulator scrutiny is several drills later. Quarterly DPDPA reviews. Your first one at day 90. Independent audit if you're an SDF. Annual. Plan for the first one in year 1. Target. Full operative readiness by May 20th, 2027. That's 18 months from the rule notification on November 14th, 2025. The clock has been running since then. You don't have time to waste, but you have enough time if you start now.
Let me leave you with one question, the same one we ended Module 1 with. If a regulator walked into your office tomorrow morning and asked you to produce evidence that you are DPDPA compliant, what could you not produce? That is the gap. That is your roadmap. That is the work. Start there. Start now.
Course recap. What you now know. Module 0. Why DPDPA exists, the framework, the players, the rights, the penalties. Module 1. How DPDPA fits onto your existing RBI obligations. Your role as a fiduciary, the SDF question, the data flow map as foundation. Module 2. Consent in lending. Product-wise, channel-wise. Universal versus explicit. Bureau pulls across the life cycle. The notice naming every party. Module 3. Consent through intermediaries. The LSP reality. The 6 clauses your LSP agreements need. Co-lending between two fiduciaries. Revocation cascades. Validity, expiry, post-closure deletion. Module 4. Implementation. Data flow mapping in detail. DPI as done well. Vendor management as a program. Breach playbooks before you need them. The 90-day build. Module 5. Real-world scenarios. DSAR end-to-end. Correction and the cascade. Erasure with the 2-bucket model. Breach response on your side and the partner side. The 30-day action plan. From principles to practice. From understanding to action.
That's Module 5, and that's the course. 6 modules, 25 lessons, and roughly 2 hours of content. Built to take someone from I've heard about DPDPA to I know exactly what needs to be built, in what order, and by when. Before you leave, there's one thing I want you to remember. DPDPA is not going away. The rules are notified, the dates are gazetted, the Data Protection Board is operational. And May 2027 is the date by which lending business must be ready. That date is not moving. But the good news is this is achievable. The work is real, but it is finite. If you approach it by section, step by step, it gets done. The businesses that start now will be ready. The businesses that delay will struggle. That's the choice. Start now, build well, operate honestly, and treat customer data the way you would want your data to be treated. Thank you for taking this course and best of luck with the build.